Hello.
Yes.
Good afternoon, ladies and gentlemen, and a warm welcome to everyone in this webinar on legislation and practice of transfer pricing in SAARC countries, organized by the Committee to Study Fiscal Regimes and other statutory requirements of business in SAARC countries of the South Asian Federation of Accountants SAFA in technical collaboration with the Institute of Chartered Accountants of Nepal ICAN. As we all know, transfer pricing is an emerging issue not only in the SAARC countries but across the globe. Today's webinar mainly focuses on two areas related to transfer pricing. First, on the transfer pricing legislation and practices in South Asia, and second, on transfer pricing database for SAARC countries, the challenges and way forward. Hence, the program will feature expert insights and experience sharing from esteemed speakers across SAARC countries, focusing on transfer pricing legislation and practices in the region, challenges faced in implementing transfer pricing regulation, and the way forward related to TP database. Before we proceed with welcome note, I'd like to kindly and briefly explain the flow of the webinar. In the first part, we will have welcome note, keynote speech, and speeches from guest speakers. We are expecting to wrap up this part in around 30 minutes. In the second part, or the first technical session, we will have speakers from SAFA member bodies delivering their presentation on transfer pricing legislation and practice in the respective countries. We have speakers from 6 different countries who will be assigned 10 to 12 minutes each for their presentation. In the second technical session, we will have presentation of around 20 minutes on TP database for SAARC countries, challenges and way forward. In the third technical session, that will be a question and answer session where we will be trying to addressing the questions of participants from the subject matter expert, speakers and presenters of today's webinar. And finally, we will be formally concluding this webinar with closing remarks. We hope we will have active participation of you all throughout this webinar. Also, as we have a question and answer session in the third technical session, we'd like to kindly request all the participants to put forward your queries or questions, if any, on today's topic via chat box. We will be trying to cover as many questions as possible in the Q&A session. Now moving ahead, I'd like to kindly request the council member of ICAN and the chairperson of Committee to Study Fiscal Regimes and other statutory requirements of business in SAARC countries of SAFA, CA Dr. Sunil Devkota sir, to deliver welcome remarks in this program. Over to you, sir.
Thank you, Gaurav. Good evening, distinguished guests, speakers, and the participants. It's an absolute honor to welcome you all on behalf of SAFA Committee to Study Fiscal Regimes and other statutory requirement of business in SAARC countries in this webinar on transfer pricing practices in SAARC countries. Talking about the context, in today's interconnected world, transfer pricing has become a pivotal issue for businesses, tax authorities, as well as the policymakers. As companies are expanding their business operation across borders, the need for a balanced, transparent, and fair approach to transfer pricing has become of enormous importance. Recognizing the challenges posed by transfer pricing manipulation and profit shifting, governments worldwide, including those in our region, SAARC region, have implemented transfer pricing regulations to ensure that related party transactions are conducted at arm's length prices. Transfer pricing legislation has evolved over time in our region, reflecting challenges in the international tax standards, economic conditions, and the need to combat tax avoidance and evasion. So we all agree that the SAARC region is home to diverse economics and unique tax frameworks. This region has vibrant economics and inter-regional trade is increasing. Having said that, this region faces both opportunities as well as challenges when it comes to the subject of managing transfer pricing. Despite the existence of transfer pricing regulation in our member countries, There is a growing recognition on the need for harmonization and cooperation in transfer pricing matters to facilitate cross-border trade, promote investment, and combat tax avoidance. Differences in regulatory frameworks, tax policies, and economic conditions across member countries of SAFA make the issue of transfer pricing both complex as well as fascinating. In this context, I want to share with you that our committee at SAFA level is also undertaking a comprehensive study on transfer pricing legislation and practices in SAARC countries and has concluded the framework for the study. The study is being undertaken with a motive to enhance understanding, promote compliance, and foster cooperation in this critical area of international taxation. So as a part of this comprehensive study being made by our committee, we are privileged to organize this webinar. This webinar aims to disseminate to the participants an overview of transfer pricing regulations and enforcement mechanism in each SAARC country, an analysis of key challenges and area of improvement, and to provide a comparison of transfer pricing practices and approaches within our member countries. Further, the webinar intends to explore the dynamics, extend insight, identify the best practices and opportunities, and foster regional collaboration for our mutual benefit. Our committee is indebted to the President, Vice President, and all the board members of SAFA for the encouragement and motivation to the committee for organizing this webinar. Special thanks to the President of ICAN, Institute of Chartered Accountants of Nepal, for his rigorous involvement during the preparation phase of this webinar. We are privileged to have with us today the President of SAFA, Mr. Yasna Kurupu, and the Vice President of SAFA, Ashfaq Yusuf Tola, as the keynote speaker. I am sure that we will get to know their perspectives and insight regarding transfer pricing in this region. The President and Vice President of ICAN, Mr. Praveen Kumar Jha and Mr. Nilbahadur Sarumagar, respectively, will share their experiences as guest speakers. In the technical session, our colleagues from Institute of Chartered Accountants of Bangladesh, Mr. Sabir Ahmad, Ms. Shoshan Said from Maldives Inland Revenue Authority, Mr. Shailendra Upriti, a tax legal consultant based in Nepal and a member of Institute of Chartered Accountants of Nepal, Mr. Mohammad Raja, a consultant based in Pakistan, and Ms. Sarmain Tilekratne from Sri Lanka will brief us on the regulatory frameworks on transfer pricing that is being adopted in their respective countries. An esteemed panel of experts comprising of Mr. Manit Dalal, who is a director of Exide Advisor Limited, and Dr. Sanjay Kumar, who is an expert on transfer pricing and a former employee of Indian Revenue Services, will share insights on recent development, challenges, and best practices in the region, particularly related to the transfer pricing. Through their perspective, we hope to uncover actionable ideas to navigate this evolving landscape effectively. I encourage all the participants to actively participate in today's discussion, ask questions, and also to share their thoughts. We acknowledge that it is through such collective dialogue that we can address the complexities of transfer pricing we are facing in our region and move towards greater regional cooperation. Once again, thank you for joining us, and we are excited to see the number of attendees, which is 206 as of now. With such a huge participation, all the members of our committee are confident that this webinar will both be insightful as well as impactful. So let us make the most of this opportunity to learn, share, and grow together. Once again, let me take this opportunity to welcome you all to this webinar. Thank you. And with this brief note, I request Mr. Gaurav Khatira to move forward with the starting of the session. Mr. Gaurav, so I now hand over the time to you. So let us begin. Thank you. Thank you so much for attending this webinar.
Thank you, sir. Thank you very much for your welcome remarks. It was indeed honored listening from you. Now moving ahead, we have now a valuable keynote speech. So for this, I'd like to kindly request the President of SAFA, Mr. Yasna Kurupu, sir, for his valuable keynote speech. Over to you, sir.
Thank you. Dr. Sunil Devkota, Chairman, Committee to Study Fiscal Regime and Other Statutory Requirements in SAARC. my friend Ashfaq Tola, Vice President SAFA, CA Prabin Kumar, President ICA Nepal, and CA Neil Maga, Vice President ICA Nepal. I would like to take this opportunity to thank the committee for organizing this timely topic, because staying compliant is not about ticking a type of a box and say we have complied, but navigating through some of the revolving legal aspects. So in that context, I think transfer pricing and related regulations are playing a key role. And I'm happy to see you are organizing it for the benefit of all the SAFA countries. Profit shifting, base erosion is an issue discussed internationally, in addition to transfer pricing related discussions happening with regard to intercompany and group related transactions. So this can lead to different aspects and shifting through increased asset values, through purchase and sales of products, or through intangible assets, etc. So understanding how do we do planning without evading is a critical area. I think finance professionals need to have this idea. So in this backdrop, I think today's session will provide more insight, and happy to note the lineup of areas that you are going to cover, including different legislative environment in the region. Current practices adopted by different countries will be discussed during these sessions. And then I'm sure they will share the learnings and challenges, as well as the common issue everyone encounters, the access to information and databases. How do we overcome this challenge is another aspect I believe we can deliberate. So with that note, more than me talking, I think there are experts in this forum, so let them talk on the relevant subject. So I wish everyone thought-provoking discussion, and I thank the committee for organizing this timely topic. Thank you very much.
Thank you very much, sir, for your deep and insightful keynote speech. Now it's time for the remarks from our guest speakers. First, I'd like to request the President of ICAN, CA Pravin Kumar Jha, sir, to deliver his remarks.
Thank you, Gauravji. Committee Chair of the Committee to Study Fiscal Regimes and Other Statutory Requirements of Business in SAARC countries, Dr. Devkota. SAFA President, Mr. Hesana Kurupu. SAFA Vice President, Mr. Tola. Vice President of ICA Nepal, Mr. Neil Bahadur Sarumagar, and all guest speakers, audience, ladies and gentlemen, good evening and heartfelt greetings from Nepal. Namaskar. It is truly an honor to be here. As the guest speaker of this insightful program, I extend my heartfelt gratitude to the SAFA committee, including Chair Dr. Sunil Devkota, SAFA Secretariat, albeit as ICA Nepal, personnel for inviting me to address this webinar. I also would like to congratulate the team for assembling such a distinguished guest of speakers and audiences. Transfer pricing is a subject of critical importance in today's interconnected global economy that we are all aware of. Our region has witnessed significant developments in transfer pricing legislation and practices, with multinational corporations expanding operations across borders. There's a need for clear, consistent, and effective transfer pricing policies, and then that these cannot be overstated. It ensures fairness. This should ensure fairness, transparency, and compliance with the international standard, while enabling governments to safeguard their tax bases. The objective, as all of us know, is that each state should get their fair share of profit to taxes. This afternoon's program has brought together some of the brightest minds in the region to discuss the legislative landscape and practical challenges of transfer pricing in our region. I'm confident that the insights shared by these distinguished guests will spark meaningful dialogue and understanding, enhance our understanding, and guide us towards best practices for transfer pricing across our region. For us in Nepal, this is of utmost importance as we have just rolled out the transfer pricing guideline applicable from the year 24-25 only. The takeaway that our local participants shall have from this program will be immense. I'm sure getting an opportunity to hear from expert speakers who have first-hand experience in dealing with transfer pricing issues, methodologies, valuation, base erosion, and profit shifting concepts, controlled and uncontrolled transaction, comparability, and advanced pricing arrangements, etc., will help us navigate the challenges brought about by the new transfer pricing guideline, which has just been rolled out. And this will help us to understand the opportunity that it would bring to our practice and profession. Finally, once again, I would like to thank the organizers for hosting this vital discussion, and I look forward to an engaging and productive session ahead. Thank you, and I wish everyone a successful program. I'll be listening to whatever is being discussed, and then I will also take away some of the things from this program. Thank you.
Thank you very much, Praveen sir. Thank you indeed. Now moving ahead, may I now kindly request the Vice President of ICAN, CA Neil Bahadur Sarumagar sir, to deliver his remarks. Over to you, Neil sir.
Thank you, Gauravji. Namaste. Good evening, Chairman of the Committee, President of SAFA, Mr. Asna Kurupu, Vice President of SAFA, Mr. Asfaq Yusuf Tola, President of ICAN, Mr. Praveen Kumar Jha, guest speakers and panelists, ED of ICAN, and ladies and gentlemen. First of all, congratulations to the SAFA committee to study fiscal regimes and other statutory requirements of business in SAARC countries, especially the chairman, Dr. Sunil Devkota, for organizing this very important seminar on transfer pricing, which is very important, very relevant now in the context of Nepal, as we are moving towards the implementation of transfer pricing with the introduction of a new transfer pricing guideline 2024. It is my pleasure and privilege to speak here today as the Vice President of the Institute of Chartered Accountants of Nepal. ICAN has long been a leader in excellence and professionalism, committed to streamlining and strengthening the accounting profession and contributing to Nepal's broader economic development. The focus of today's discussion, legislation and practice of transfer pricing in SAARC countries is both timely and essential in our context. In Nepal, after a long wait, transfer pricing guideline 2024 has recently been issued by Inland Revenue Department, and it now has become a central topic for professionals and business community to discuss. However, as with any regulation, first-time adoption presents a range of challenges, both for business striving to comply and for the regulators tasked with enforcement. I believe programs like this seminar play a vital role in fostering collaboration and knowledge sharing. They will help professionals with the tools to navigate these challenges while enhancing the regulatory capacity needed to ensure effective compliance with the new guidelines. The introduction of transfer pricing guideline marked a pivotal moment in Nepal's tax landscape. The guidance aims to address the challenges of globalization, particularly by preventing profit shifting by multinational companies and ensuring that Nepal secures its fair share of tax revenues from such MNCs. I believe there are a host of challenges ahead in implementation of transfer pricing guideline in Nepal's context. For example, we have a lack of expertise and awareness, I think, which is one of the major challenges as far as Nepal is concerned. As you know, transfer pricing is a specialized field requiring technical expertise, which remains limited among professionals and businesses in Nepal. SMEs in particular struggle to understand their compliance, obligations, and requirements. Similarly, tax administrators require significant training to handle the complexities of transfer pricing, audits, and documentation. Similarly, scarcity of comparable data is another important challenge in the context of Nepal. Since arm's length principle is a cornerstone of transfer pricing. It requires transactions to be priced as if it is conducted between the unrelated parties. So Nepal lacks access to reliable data for comparable uncontrolled transactions, making it difficult to establish benchmark for compliance. Further, in my view, the administrative constraint is also very it's also very important. I mean, the challenges in that respect is also very important because the tax authorities are still building capacity to conduct effective transfer pricing audits. The extensive documentation requirement can be overwhelming for both business and regulators, leading a delay and inefficiencies. So as you know, South Asia is growing. So investment from the MNCs are growing in South Asia. And so I think the challenges that we have in Nepal is not unique to Nepal. So our South Asian counterparts also have got similar kind of problems. So in this context, fostering regional collaboration is very crucial. So by sharing knowledges, expertise, and success stories, as well as by establishing regional level databases and by improving our legislative frameworks, we can collectively address the issues or challenges being faced by us in the regional level. Hence, such cooperation will not only bolster economic growth, but also mitigate the adverse effect of globalization in our region. So at ICAN, we are working closely with the authorities to ensure the seamless implementation of transfer pricing in Nepal. So we have recently reviewed the transfer pricing draft regulation issued by the IRD, and we have submitted our comments on the draft regulation. And after the same, IRD has issued the transfer pricing guidelines also. And basically, as ICAN, we are working in 4 fronts in order to have that, in order to have the seamless implementation of transfer pricing in Nepal. First being the capacity building. ICAN is in partnership with our stakeholders like ACAN and ODAN. We are planning to launch a series of events and programs in training our members to be ready to help the business in Nepal to comply with TP guidelines. Similarly, we are also advocating for the simplified compliances. We understand there is a challenge in compliance with TP guideline at this moment. Hence, we are advocating for the simplified compliance with authorities. Third, we are also collaborating with authorities. We are actively partnering with the Inland Revenue Department of Nepal to address the gap in implementation and understanding. I think there are certain aspects in transfer pricing guideline issued as of now in Nepal, which otherwise should have been covered if you look at the transfer pricing guidelines issued by OECD. For example, there are no safe harbor rules which simplify compliance for the smaller taxpayers. Similarly, clear provisions for making primary and secondary assessments are not there. So there is also a lack of public comparative database, making it very difficult for any businesses to determine the arm's length pricing. So in this context, it is very important from ICAN's perspective and from the perspective of our members to closely work with the authorities in order to address those issues and to make it easier for the business to comply with the transfer pricing regulations. And for the other important aspect that we are trying to do in Nepal is to raise the awareness. Since transfer pricing, though it was there in the law long back, but then the guideline was it was issued recently. So there is a lack of awareness among the businesses with respect to the compliance of transfer pricing. So we are planning to host a couple of programs to raise awareness on the compliance of transfer pricing. And last but not the least, we are very fortunate today to have distinguished panelists with decades of experience in transfer pricing at the regional and global level. Their insights will be invaluable in shaping the future course of transfer pricing in Nepal. So on behalf of ICAN, I extend my best wishes for the success of this program. Together, let us work towards building a robust transfer pricing framework that fosters transparency, compliance, and economic growth in our region. Good evening and thank you.
Thank you. Thank you very much, Neil sir. With the remarks from Neil sir, we have come to the conclusion of inaugural part of our webinar. I'd once again like to thank all the esteemed speakers for their valuable remarks on the theme of this webinar. Now we move to the first technical session of this webinar, which comprises of experience sharing by distinguished personalities on transfer pricing legislation and practices in South Asian countries. Before we begin with the proceedings of this technical session, I'd like to kindly provide a brief overview of the time allocation for this session. Each speaker of this session will be provided with 10 to 12 minutes of time for your presentation. For your convenience, we will display a timer with reverse countdown of 2 minutes after completion of around 10 minutes of your presentation. Hence, we kindly request our esteemed speakers to plan and deliver your presentation accordingly. For experience sharing, first we have representative nominated by the Institute of Chartered Accountants of Bangladesh, ICAB, Mr. Sabir Ahmed. Mr. Sabir is a fellow and council member of ICAB and was elected as Vice President of ICAB for the year 2020. He is a partner of Hodavasi Chaudhary and Company, one of the largest and oldest chartered accountants firm in Bangladesh, previously known as A.F. Ferguson and Company. With nearly 25 years of professional experience, he has more than a decade of international experience of working with one of the big four firms in various countries. He will be sharing his experience about TP legislation and practices in Bangladesh. Now, I'd like to hand over the floor to Sabir sir for his presentation. Over to you, sir.
Thank you, Gaurav. First of all, I feel humbled with the long introduction you have given. So thank you. Thanks once again to ICAN for organizing this seminar. If I'm allowed to share my screen, just give me 30 seconds. Okay. Gaurav, can you confirm it's visible and I am audible, I hope?
Yes, sir, you are audible.
Okay, wonderful. Given the short time, I just prepared a couple of slides to give you an overview of the legislation related to transfer pricing in Bangladesh. The transfer pricing is applicable for international transaction between associated enterprises. At least one of those associated enterprises need to be non-resident in Bangladesh. So if the both associated enterprises are based in Bangladesh or resident entity in Bangladesh for tax purposes, then transfer pricing is not applicable. In other words, in Bangladesh, there is no concept of domestic transfer pricing. So it is only related to international transaction when either or both entities in the transaction are non-resident in Bangladesh and they are associated enterprise. International transaction definition is very stock standard. Any type of business transaction, buy, sell, transfer of tangible, intangible assets, loans, all these are covered under international transaction. In addition to the direct international transaction, indirect international transaction through use of one or more than one intermediaries are also captured under the purview of international transaction. Then a very critical distinction or definition is relating to associated enterprise. So associated enterprise has been defined under a number of criteria. One is the management and control of capital. Another is the shareholding, then appointment of board of directors or equivalent, giving of loans, giving of guarantees, then through direct or indirect intervention when you have above a certain threshold of influence on that company, this is considered as an associated enterprise. Finally, there is an omnibus clause, two omnibus clause, where one is said one enterprise has the practical ability to control the decision of the other enterprise, then both will be considered as an associated enterprise. Or two enterprises are bonded by such relationship of mutual interest as may be prescribed. So the tax authority may issue various rulings whereby if they determine that there are an existence of mutual interest, then they might be termed as an associated enterprise. So it's a very prescriptive list. Other than the last two that I have discussed, most are quite objective criteria where a very minimum amount of subjectivity involved. Following the OECD guideline, the 5 methods of determining arm's length transaction is allowed under the Bangladesh transfer pricing legislation. First is the comparable uncontrolled price, then resale price, cost plus, profit split, and finally transactional net margin. Again, there is an omnibus clause that if there are any other method that the SSC can demonstrate which is most suitable for them to assess arm's length transaction, then they can use that particular method, bypassing all these 5 prescribed methods. But here the onus would be on the SSC to demonstrate that this method that they have selected is the most suitable for that particular circumstances. Our transfer pricing legislation do have a safe harbor limit in the local currency amount for documentation requirement as well as reporting requirement. So the reporting requirement, one is required to maintain certain documentation to support your arm's length basis. That includes like ownership profile, transaction profile, as well as various type of activities, functions, risks taken by the local enterprise as well as overseas associated enterprise that is transacting with the local resident entity. Couple of external requirements that need to be submitted along with the income tax return. One is the called statement of international transaction that transacted during the year, as well as balance as of date or cutoff date that need to be enclosed in a defined format along with income tax return, and that need to be submitted along with the income tax return to the Deputy Commissioner of Taxes. In addition, there is a requirement to submit accountant's report where the accountant, it can be a practicing chartered accountant, or it could be practicing cost management accountant. They are required to certify about the correctness of those international transactions. So these are the 2 documents that need to be submitted to the tax authority along with the income tax return. As I said, in addition to those, the SSC required to maintain certain documentation to support the arm's length basis. It could be transfer pricing study. It could be in the form of like analysis of risk taken by particular entity for which they are receiving the payment. Just a brief overview of how the transfer pricing is assessed in Bangladesh. One thing that the transfer pricing legislation brought in few years back, actually it was in 2015, so almost 10 years back. While introducing this transfer pricing legislation, government took a fair bit of consultative process. And as you know, like any other developing country in the region, we are very much focusing on the foreign direct investment. And unfortunately, there have been instances of substantial disputes with many foreign investors in Bangladesh relating to the tax. And that is, again, not unique to Bangladesh. All the other countries in the region are having the similar type of issues. So from the, excuse me, from the professional community as well as business community, there was a submission to income tax authority and the government that please do not create another battlefield where this transfer pricing will become another area of loggerhead between SSC and the tax authority. Especially these SSCs are foreign investor mostly, so that will have a fair bit of negative consequences for the foreign direct investment as well. So that's why the way it is structured is once an SSC who is having an international transaction with an associated enterprise, they will submit the income tax return. Along with that, the statement of international transaction that I just spoke a few seconds back need to be submitted. The DCT, once they saw that this is the entity where there is an international transaction involved, then they will not assess that international transaction because it required quite specialized knowledge. And that is why our tax authority called National Board of Revenue, they have created a separate specialized wing called Transfer Pricing Desk. So the DCT will refer that international transaction statement to dedicated transfer pricing desk of NBR, so that those desks can review the arm's length basis instead of DCT applying, because many of the transactions will require specialized knowledge. And I will come back in a minute. One of the critical element or challenges is the availability of the data. So therefore, that part will be dealt by dedicated transfer pricing desk. So they will analyze, and if they are satisfied with the arm's length basis of the transaction is fine, they will inform the DCT that yes, there is no action need to be taken. Or if they identify that no, arm's length basis is not right, there is an upward adjustment that need to be taken that will result in increased tax obligation, then they will refer that matter back to the DCT, saying that because of this non-arm's length basis, there will be an additional adjustment of X amount to its tax obligation. So DCT will consider that recommendation from transfer pricing officer or a transfer pricing desk, and then include with his or her other normal assessment adjustments. So that way, once DCT has incorporated the transfer pricing referral as well as his or her own adjustments, if any, then a notice will be issued to the SSC. So from then on, it will be a very normal process. So if the SSC or the taxpayer agrees with the adjustment that has been identified by DCT, they will comply with. If they believe that the DCT's action is not in accordance with the law or according to their expectation in line with the best practice, then they will go through the appeal process. So this is, in a nutshell, is an assessment process where a normal assessment will take place only for the transfer pricing method. It's the DCT will refer this matter to a centralized cell called transfer pricing desk. Finally, I think a number of my previous speaker has already discussed about one of the biggest challenges is availability of data and information, especially country specific, because we do use a number of database that has been developed regionally by some of the professional institutes as well as global database. But one of the challenges is those data not necessarily in line with our socio-economic condition or macroeconomic condition. So again, we have to do certain adjustments to get the right, comparables. So this is an area where there is a challenges, and I note that there is a discussion by some expert about the development of a regional database. I think this will be an excellent idea. What we have done from our Institute of Chartered Accountants in Bangladesh, in line with SAARC's UDIN, we have also introduced what we call the document verification system, or DVS. So where if I, as an auditor signing off any statutory financial statements, I have to auto-generate a unique identification number. And in order for me to generate that unique identification number, I have to key in certain information like total revenue, profit before tax, total assets, and some other things. So what we are discussing, that when we will insert those data, whether we can expand those data fields where the necessary informations are captured, and that database can be also used for multiple purposes. One of them amongst is arm's length or comparable study of for transfer pricing. In a number of developed countries where I worked, or OECD countries I work, there is an advanced ruling mechanism. But in Bangladesh, the tax authority is still a bit reluctant to introduce this advanced ruling mechanism, because they also think that they need to have good understanding before they will allow advanced ruling by the SSE or by the taxpayer. One aspect of late is coming to our attention, and the tax authority also raising noise, is, as you know, in Bangladesh, one of the biggest export is the garments. So a lot of foreign buyers have buying a house or a liaison office in Bangladesh, primarily to ensure the quality control and to help with the logistics of shipping on timely basis. But growingly, some of these buying houses have expanded their activities. It's not only confined to the quality control, rather it has also started to create value addition work. So there is a concern that whether their activities are purely confined to the mandated quality control work, or also they are doing a lot of value addition work for which Bangladesh tax authority is deprived. And so this is also some sort of, a profit shifting mechanism. So this is a growing area. So in a nutshell, I think, as we all know, that base erosion and profit shifting is a global phenomena. OECD a couple of years back has introduced Pillar 2 requirement to have minimum 15% tax. A number of other control mechanisms like foreign controlled entities, withholding tax, disallowances of certain intercompany charges are included in various tax legislation. Transfer pricing is a latest addition, which various countries have incorporated in the last 10-15 years. Bangladesh perhaps 10 years back, but real implementation started only a few years back. Nepal has just started the journey. So I think through collaborative approach, we can learn from each other and we can help each other. Thank you so much.
Thank you. Thank you very much, Sabir sir, for your presentation. Next, we have representative nominated by the Institute of Chartered Accountants of India, ICAI, CA Siddharth Panwar. Apologies if I pronounce your name incorrectly, sir. CA Siddharth is a tax professional turned tax entrepreneur and is a founding partner of S. Panwar and Associates LLP Chartered Accountants, Mumbai. He is a co-founder and managing partner of Yubze Consulting LLP. He has been handling practice areas of taxation, including international taxation, transfer pricing, transaction advisory, and implementation valuations. Prior to his own professional venture, he was a partner with TP Ostwal and Associates LLP Chartered Accountant based in Mumbai. He will be sharing his experience about TP legislation and practices in India. Now I'd like to hand over the floor to Siddharth sir for his presentation. Over to you, sir.
Thank you very much, Gaurav, for your kind introduction. Thank you to the entire SAFA organizing team for giving this opportunity to come and present my thoughts on transfer pricing experience in India. Just want to confirm if my presentation is visible.
Yeah, presentation is visible and you are audible too, sir.
Okay, thank you. So, just now I heard the initial background about how transfer pricing has been evolving in the region. Some countries have just adopted, some countries have adopted 10 years back. India is one of the countries which had adopted it in 2001. Yes, initially few years it took some time to take off, but now we have a lot of development. Transfer pricing regulations have evolved, the experience in the country have evolved. We'll see how the transfer pricing regulations have evolved over the period of time in India. What are the new legislations which India has introduced, keeping it par with the international development at G20 or OECD, countries meetings. United Nations, India has been contributing and trying to bring about, the changes which are required in the international framework from a developing country point of view. When we look at the SAARC region, these are the countries where there is a lot of industrial opportunities which are there. These are regarded as developing countries from the perspective of the Western world, and that is where we see a lot of transfer pricing litigations arose in the past few years. While transfer pricing laws were being implemented by the developing countries because the fair share of their taxation rights were being claimed by the developing countries as well. So just a quick recap to the global development on transfer pricing. US was first country to adopt transfer pricing in 1968, and that was predominantly because US has a two-tier taxation system where they have the federal tax and the state taxation, and therefore because different states followed the different taxation regime, they brought in transfer pricing qua different states. OECD then came out with a transfer pricing framework in 1979 and 1984. They updated it, and then later on in 1995, for the first time, they issued transfer pricing guidelines, which were later updated in 2010 and 2017. On the similar lines, initially, United Nations also adopted the OECD framework, but of late in last 10 years, United Nations has taken a step ahead and started bringing out issues from a developing country's point of view, and United Nations transfer pricing guidance or reports guidelines are helpful from developing country perspective. India introduced transfer pricing in 2001 because the financial year in India starts from April to March. It was effective from 1st of April 2001. It was predominantly based on the OECD framework, but that's how we began, and later on over the period certain basic construct in the framework continued to remain in as per the international framework, but there were a lot of developments which took place from the jurisprudence point of view based on the experience which India has on the local front. As a holistic history, or a look back to the entire evolution process, 2001 it was introduced. 2004-5, I would say principally it was adopted in practical sense when the first type of litigations or assessment began, and we saw some of the case laws coming in from the appellate authorities in those years. After 2008, pretty much the volume increased. Both the sides got practical experience of dealing with the transfer pricing laws, and that is where dispute resolution panel and safe harbor rules saw their introduction in 2009. 2012, India introduced specified domestic transaction. It extended the scope from international transaction to even domestic transaction. There were modifications to certain nature of specified domestic transactions over the period of time. Though today, as we continue, specified domestic transaction or domestic transactions, which predominantly would take into account entities or those units which are claiming certain tax incentives or are claiming tax holidays, those are subjected to domestic transfer pricing, so that there is no profit shifting domestically between these entities as well. From benchmarking point of view, India saw a lot of experience and evolved over the period of time. So permitted rules were modified to permit use of multiple year data to arrive at comparability, because it was realized that transfer pricing is not an exact science and it requires a lot of adjustment when it comes to the commercial world. And it also realized that businesses do see different cycles, and that is why an average theory was brought in. There was advanced pricing arrangement which was brought in the statute, and in last few years we have seen that Indian government has engaged with different countries in getting bilateral issues resolved through bilateral advanced pricing arrangements. And domestically, if an entity wants to go to the authorities and have a certainty, can make an application for advanced pricing arrangement. And later on, I'll just explain what briefly that concept is. 2016, India aligned itself with the international requirement of country by country reporting. In 2017, it also observed that while the primary adjustment was being made, the amounts were not being remitted or returned back to the Indian jurisdiction, which was having an impact on the revenue cycle. And accordingly, what happened is principally secondary adjustment concept was brought in on the lines of OECD BEPS framework of, discussion on thin capitalization. India tried to introduce a limitation on interest deduction in case of related party transactions. So these frameworks were brought in. Safe harbor rules with a new framework based on the past experience was introduced. Rates are being notified year on year basis, and which is being implemented. From a overall holistic point of view, we saw the presentation on the Bangladesh side. We saw that, the definitions of associated enterprise, international transaction, since there was no specified domestic transaction there, here we have the definition of specified domestic transaction, methods of computation of arm's length, the 5 prescribed methods which are there, and 6th method, which basically gives a leeway to adopt any particular methodology to arrive at the arm's length standard for a transactions where normal transactional methods may fail. So resale price method, transactional, comparable uncontrolled price method, transaction net margin method. All these are standard methods which are prescribed globally, have been adopted over the period of time. Some of them requires, utilization of third-party database to collect that information. Thankfully, in India, the databases locally are quite strong. A lot of companies' data is available. However, it becomes challenging at times, to get details of private companies which are not required to publish their accounts publicly. Though many databases do have access to some of the private company data, but there are again challenges while navigating the data, because this is not something which gets updated on real-time basis. So normally the transfer pricing documentation which is maintained is updated while the audits and assessments are being taken care of. So corresponding law provides for the provisions with respect to safe harbor secondary adjustment, which I have already explained. Documentation front, as far as international transactions are concerned, there is a basic threshold of 10 million Indian rupees, beyond which every entity having an international transaction is required to maintain a detailed documentation and is required to submit to the authorities as and when called for. In cases of domestic transaction, there are basic threshold for reporting purposes as well. As far as international transaction, even a single rupee of transaction is subject to reporting. Initial framework for reporting requirements, broad transactions were covered. India came out with a detailed definition of international transaction, and now the reporting framework on an annual basis, which is required to be obtained. An accountant's report is also required to be obtained in that regard. Requires transactions to be broken up into different pieces relating to, traded goods, manufactured goods, services separately, financing transactions separately, other transactions separately. So that's the framework which has been brought in for reporting purposes. Country by country reporting framework, that's in line with the international requirement. I would not spend time on the methodologies which have been prescribed. We have already heard about what these methodologies are. These are principally aligned with the international thought process which is there, though practically there are different nuances and experiences which we have seen, basis which the jurisprudence has developed over the period of time. As far as approach to determination of most appropriate method is concerned, what the law provides or prescribes is basically identification of transaction, performing function, asset, and risk analysis. India has also been propagating, function, asset, and risk, and also equal weightage to the market condition, because it's a developing country where marketplaces are there, and it's been thinking and bringing that to actual implementation as well. After selection of method, economic analysis is done and calculation of arm's length price is required to be done. From a global reporting point of view, if there is an Indian parent entity which has a group turnover of more than 5,500 crore, which is approximately 750 million at the time when the threshold was prescribed in INR, that entity, if at a global level, has a group turnover of more than 5,500 crores, is required to file country by country reporting as well, which is a detailed international reporting requirement. In case if Indian entity is part of a global conglomerate and there are agreements entered for exchange of information on country by country reporting mechanism, then in that case, there are separate prescribed forms which are required to provide information as per the local documentation which is required to be maintained. Beyond this, there is also local documentation anyways required to be maintained. So these, India is quite aligned in terms of its requirement and in terms of what is globally required. Very quickly, from the procedural point of view, reporting obligation is there based on the return filing deadlines. Then, in case if the case is selected for transfer pricing assessment, it is being made, reference is made to the transfer pricing wing. We have a dedicated transfer pricing wing which carries entire set of officers, chain of officers who are specialized and dealing with the transfer pricing mechanism. There is similarly dedicated appellate benches also dedicated to transfer pricing litigation to take care of that. And very quickly, in a couple of minutes, I would conclude the flow. In the process, transfer pricing officer, once the reference is made, issues notice, seeks information and documents, which is the part of TP audit process. Generally, basic information is called for. Subsequent clarifications are called for before making a final adjustment. A show cause notice is required to be given. Once the show cause notice is given, that's the opportunity for taxpayer to defend their position and understand what adjustment, upward adjustment is sought to be made. After considering the reply to the show cause notice, order is passed. Based on that order, assessment order is passed by the normal assessment wing, which is now, in India, is basically a faceless framework where it goes to the regular officer who then, passes a draft order, which is subject matter of a dispute resolution panel, which is intermediate appellate forum, which resolves the dispute in case if reference is made to their directions are given by them for filing the final order. And in case if appellate, assessee wants to choose to go to an appellate mechanism directly, it can go to the Commissioner Appeals, and then that is the first appellate authority, followed by Income Tax Appellate Tribunal, High Courts, which are regional jurisdictional courts, and Supreme Court, which is the Constitutional Court. So India has, on an alternative dispute resolution mechanism framework, has adopted dispute resolution panel as a mechanism to fast track litigation and reduce adjustments and controversies. Safe harbor rules, pretty much in alignment with the local requirements as prescribed, rates which are there. From time to time, people do adopt for safe harbor rule as well. On the international framework, India has a detailed mutual agreement procedure and APA, which is bilateral negotiated with other countries to resolve disputes. There is a framework for secondary adjustment as well, which is basically to ensure that any primary adjustment which is made is brought back to the country and there is no one-sided adjustment which is suffered on that. Very quickly on international framework, India brought in a requirement of a limitation on interest deduction, which is basically restricted to 30% of EBITDA, a ratio which has been aligned based on the OECD recommendation. But, this is something which has been adopted as a temporary mechanism by the time Pillar 1 or 2 approaches are being finalized and adopted by the countries. Key issues: foreign comparable, choosing of comparables, locally, marketing intangible, whether marketplace creates intangible. Lot of jurisprudence, lot of matters have now reached till Supreme Court. We have seen a lot of attribution related matters being dealt by the Supreme Court as well. And as far as all neighboring countries are concerned, if at any point in time you get stuck on a particular issue, you don't find where to look at rationale when it comes to developing countries, you can always bank upon the Indian judicial precedents which are created, because we have plenty. Thank you very much for this opportunity. I rest my discussion here. Thank you.
Thank you. Thank you very much, Siddharth sir. Next, we have representative nominated by the Institute of Chartered Accountants of Maldives, CA Maldives, Ms. Sausan Said. Apologies if I pronounce your name incorrectly, ma'am. Ms. Sausan currently serves as a manager at the Maldives Inland Revenue Authority, where she leads a team of international tax auditors with over 7 years of experience in auditing and taxation. She specializes in cross-border taxation. Ms. Hossain is a fellow member of the Institute of Chartered Accountants of Maldives, CA Maldives, and a member of the Association of Chartered Certified Accountants, ACCA. She will be sharing her experience about TP legislation and practices in Maldives. Now I'd like to hand over the floor to Hossain ma'am for her presentation. Over to you, ma'am.
Thank you so much, sir. Let me just share my screen. Can I confirm if you're able to see my screen?
Yes, ma'am. Your screen is visible and you are audible too.
Okay, thank you so much. So let me start. Thank you for the introduction. Good evening and assalamu alaikum. So I work in the tax administration, as Gaurav highlighted. So before I started, I just want to give a brief overview of Maldives. So in Maldives, our economy is primarily based on the tourism sector. So we have a very much of a tourism reliant in this economy. And we have this one island, one resort concept. So we have over 170 tourist resorts currently, and around 67% of these tourist resorts are MNEs. So some of these resorts, they are owned by the MNEs, or they can be either managed by MNEs through management agreements. So when we look into transfer pricing rules in Maldives, we have had them since 2011. So it's not a new concept to us, but in our previous BPT regime, business profit tax regime, it was a bit of a limited, it was not a comprehensive set of guidelines, and we had no transfer pricing documentation. So in 2020, we commenced under the Income Tax Act, and in it, we introduced the transfer pricing guidelines, as well as made the requirement for transfer pricing documentation mandatory on M&As. And our income tax rate is still at 15% for companies. So when I look into the associate definition, we pretty much have the same definition, I think, from the other countries that have spoken earlier. The majority focus here is on control, but we do have certain distinctions. It could be either majority share capital or voting rights, or if you are able to direct or manage the affairs of another company, it can be said that you can control. So when we look into the arm's length principle, this is something that is endorsed in our act, and it follows closely with our OECD guidelines. And it also is defined as a transitional arrangement, the terms which would have been made if they are not associates and in comparable circumstances. So we recommend our taxpayers to adopt the three-step approach, which is to conduct the comparability analysis to identify the most appropriate transfer pricing method, which we use as the 5 methods prescribed in OECD, and also we have other methods, and to determine the arm's length. So of course, it's not easy to determine coming to a single figure. So we do allow taxpayers to come up with a set of comparables, and if we have an interquartile range, which is set between 35% as lowest quartile and upper quartile at 65%. And we also allow our taxpayers to use multiple year data, and we use a weighted average. So there's no specific, we don't suggest any specific set of comparables, that there should be a limit of the comparables, or that the taxpayer should use a specific database. So when we look into transfer pricing documentation, like I mentioned earlier, this is now compulsory on taxpayers if they have a cross-border transaction and if they're not exempted from it. So it is based on a contemporaneous basis. So it must be prepared by the return filing date, but they do not need to submit it with the return. So usually when we go for a transfer pricing audit, we request the taxpayers to provide it, and we give them about 7 to 30 days to provide the document to us. And we follow the 3-tiered approach in OECD guidelines. We have the master file and local file and the country-by-country report as well. So of course, there are exemptions at entity level because we don't want everybody to be burdened with the compliance. So we have micro, small, medium business exemptions. And also at specific transaction levels, we have exemptions. For example, if there's a domestic loan, a Maldivian company, if there's a loan between 2 Maldivian companies, we don't require them to prepare the transfer pricing documentation. And also if it's a provision for routine service for which they have applied the 5% prescribed markup for the simplified method, we do not require them to prepare the TPD. And we also have this, we call it the schedule for the income tax return. It's actually part of the income tax return that they submit. They have to prepare this if their revenue is more than approximately $1.3 million USD. So this is sort of a schedule where they highlight everything that they have, where they list the value of all the transactions they have with their associates. And they also have to highlight where the shareholding is, where the ultimate beneficial owner is, and also specific in-depth information is given. So for example, if you can see from the snapshot, you can see that for purchase of goods, we ask for the associates, what is the method that you use, what is the value, etc. And we also have exchange of information. So we signed the MAC in 2021, and we have country by country reporting and CRS data available, which is from 2021 onwards. And also APAs, we have an arrangement with taxpayers. So they can come forward. This is also implemented in the Income Tax Act from 2020. So they can come forward and ask the tax administration to enter into this APA, whereby the methodology will be set for a number of years. So currently it's for 5 consecutive years. And we do allow unilateral, multilateral, as well as bilateral ones. So when we look into mutual agreement procedures, this is also a dispute resolution mechanism. So currently, Maldives has a very few double taxation avoidance agreements. So we have one with UAE, Bangladesh, and India. But with the India, we have only a very limited one, which is for international air transport. And we do allow MAPs to be initiated for transfer pricing issues, or whether there is a juridical or economic double taxation, or any residence. But to this date, there has not been any mutual agreement procedures initiated by any of our treaty partners or any of our taxpayers. So when we look into transfer pricing audit, I'm from the transfer pricing section. So we were established in 2019. It was formerly known as the transfer pricing unit, but now our purview has sort of broadened to include all aspects of international tax. So we follow the OECD guidelines and the UN practice model. And we also have a subscription to the transfer pricing database, which is the one from Bureau 26, Orbit, TP Catalyst. So we use that database to produce benchmark analysis in our transfer pricing audit. So I'll just go through the common intergroup transactions we have. So of course, being in the hospitality industry, number one, we have the intergroup financing arrangements. So we have a lot of loans, we have a lot of cash pooling arrangements, because when we talk about the resorts, we're talking about more than, sometimes it's more than $100 million investments. So these funds are usually coming from the parent company or from the associates as forms of loans. And we also have intergroup service transactions, management companies, marketing fees. These could be either from related parties, or we have independent brands that operate without any relationship, as well as branding, license fees. And also we have also noticed foreign tour operator arrangements, which are usually located in low-tax countries. So this is very difficult sometimes to identify the nature of this operation. And head office fees, loyalty programs. So when we look into financing, this is the major part of our the transfer pricing audit focus. So the test that we usually perform is the prima facie whether the purported loan should be regarded as a loan. So we do have a criteria and that we do look, which is also following closely with the OECD transfer pricing guidelines. So the factors that I've listed here, they are not at the same weight. They don't hold the same weight. We look for, so the first thing when we go for an audit would be, we would request the taxpayer to provide the contractual agreements, the loan agreements and all of this, and we will check, and then we will request them for the interest schedules and the interest calculations, and we will then match whether taxpayer's agreement and their actual conduct meet. So if there is no mismatch between both, we will rely on the actual conduct, and then we will make our analysis on it. So for loans, we also have interest. We have like specific criteria, like my previous speakers have spoken. We also have thin capitalization rules, which is fixed at 30% of tax EBITDA. So we have 3 rules when it comes to interest expense, which is the number 1, arm's length principle. The amount also has to be arm's length, the amount of loans or funds received, as well as the interest rate. And we also have a 6% cap. So for example, if your shareholder is lending you at 12%, you will not be able, if it is 12% in the arm's length rate, you will still not be able to deduct because we have the 6% cap. And of course, the thin cap rule. So we follow the OECD guideline when applying the thin capitalization rule. So I just have an example, but I will just skip ahead. Maybe I'll just go through one of that. So here we have an intergroup financing arrangement whereby the parent company and the local company, and you can see that the bank has given the loan to parent company, and the same loan has been given to the company in Maldives. But when the interest rate came, it came from 1.5% LIBOR to 12%. So in here also we see an obvious issue with the interest rate. So that is something we would be looking. Again, we would be looking whether the 45 million, whether it should actually be a loan or whether we should consider it as the other something else like a shareholder contribution. And the next one we have mostly is intergroup services. So for intergroup services, our main focus is whether the benefit has been provided. This is in practice, it is something very difficult to prove, because most of the time the management company is somewhere located in maybe in a low tax country like BVI or Cayman. So the documents are not there. So it's very difficult to prove the benefit has been obtained. And also some of them is either shareholder activity or the service can be merely duplicated with another service. So again, I've highlighted an example. So in Maldives context, what we have seen from the hospitality industry is that mostly we have a base fee and an incentive fee, which is usually tied to revenue, and a marketing fee, which is also usually tied to the gross operating revenue. And we have an incentive fee, which is sometimes tied to the gross operating profit of the company. So we check whether these rates are at arm's length, and because we have an access to the database, we are able to check whether these companies have the arm's length rate. And also tour operator agreements, when we look into tour operator agreements, I will just go through this example. This is company S here is owning a company in Maldives, which is a tourist resort, and it's a tour operator as well, and they are selling only for $200 per night for the Chinese market. But when we go for an audit, we can see that there is also an independent tour operator which they are selling for the same market for 500. So we have internal comparable in this case, which we can use to bring it at arm's length. So far the scenarios that I have explained, it's fairly very simple, but in reality, we face a lot of challenges just to determine everything. So for example, comparability analysis, we need to find potential comparables first. But in Maldivian context, because of our unique geographical features, one island, one resort concept, we have this difficulty to find other geographical markets which are very close to Maldives. And also we have the restriction on secret comparables, like my colleague from India said. The financial statement of private companies, they are not publicly available. Of course, as the tax administration, we are privy to that information, but of course, we cannot reasonably understand that the taxpayers would have access to that information. So we can't use those data in our assessment for transfer pricing adjustments. And one of the most important challenge is the information gap. Most of the documents are kept outside the Maldives, so we have very difficulty to get this information. For example, the loan agreement, the management agreement will usually be kept at the parent company, which is usually located somewhere outside Maldives. And also because of this, we do not have that capacity to do the functional analysis properly because these companies are located offshore. And of course, transfer pricing documentation, the mandatory, it was done very recently. So it is currently the transfer pricing documentation that we receive, it is not very accurate, or very much information is missing from it. So it takes a lot of time to just to go through this and to verify and the completeness. And of course, litigation, I think it's one of the major battles that we face. Currently, a lot of cases are also in High Court or at Supreme Court, and we have several decisions overturned. But going forward, we hope that the clarity would be much more. And of course, there is our training needs, which is to deal with these transfer pricing issues. That's all from my side. Thank you so much. Thank you.
Thank you very much, ma'am, for your presentation. Moving ahead, we now have a representative nominated by the Institute of Chartered Accountants of Nepal, ICAN, CS Sailendra Upreti. Mr. Sailendra is a fellow and a practicing chartered accountant member of ICAN. He has completed master degree in law, LLM from Tribhuvan University, and is currently pursuing PhD in law. He specializes in audit, accountancy, financial, and tax legal consultancy. He has recently published an article on the quarterly journal published by the Institute on the topic, Has the Game Begun? Transfer Pricing Regime in Nepal, especially focusing on the Transfer Pricing Directive 2081 issued by Inland Revenue Department of Nepal. He will be sharing his experience about TP legislation and practices in Nepal. Now, I'd like to hand over the floor to Sailendra sir for his presentation. Over to you, sir. Sailendra sir, are you there?
Just a moment.
Okay.
Okay. Thank you, ICAN and SAFA, for providing me an opportunity to share the experiences regarding transfer pricing issues in Nepal. As per our previous paper presenters, we in Nepal yet don't have any rich experiences to share regarding transfer pricing issues, as the directive has just yet been promulgated by the IRD. So I would limit my presentation regarding the topics covered by the directives alone, and later, sometime after we gain a rich experience, we would definitely share the experiences with our neighbors and wider world. So the first slide that I would like to share is regarding the definition of transfer pricing that has been, okay, I will share the full screen. The transfer pricing definition shared by OECD transfer pricing guideline is that the transfer prices are the prices at which an enterprise transfers physical goods and intangible property or services to associated entities. And the similar definition has been shared by the United Nations Practical Manual on Transfer Pricing. I'll not go into the details of definition, and I'll skip to the next slide, which is related to the Transfer Pricing Directive 2081. This directive was issued on 6th October 2024 by IRD, that is the line department regarding income tax, excise, and VAT in Nepal. The need for this directive or the transfer pricing law regime in Nepal was stressed by the finance minister in his speech, in the budget speech of 2024. And the law came in the form of a directive rather than a full-fledged law backed by the authority of the parliament. So in a sense, we can tell that this is a form of delegated legislation. The directive contains 7 chapters and 2 annexures. Now I would like to move into the chapters of the directives. There are 7 chapters in the directive. And the first chapter is the introduction, then the definition, and so on and so forth, as can be seen in the screen. The chapter 1 is basically the introductory chapter. It spells out the rationale of why the transfer pricing directive was issued by the IRD. The main essence of introducing the directive was to enable the government of Nepal to gain a fair share of tax based on ALP between the subsidiaries of multinational companies in Nepal and its headquarters. And the source of the directive is Section 3, subsection 3 of Section 33 of the Income Tax Act that was introduced in the current year's budget, that is by the Fiscal Act, Finance Act 2024. As can be seen in the screen, Section 33 of the Income Tax deals regarding transfer pricing and other arrangement between associated parties. The subsection 3 of the Section 33, which was inserted by the Finance Act 2024, provides that the transfer pricing between the associated enterprise shall be as determined by the IRD. And it is by the virtue and the authority of this Section 3 subsection 3 of the 33, that the current transfer pricing directive was issued. Moreover, the rule 15 of the income tax rules also deals with advanced pricing arrangement. The current directive is silent about APA regime, but we hope that APA regime would be introduced at a later stage as we advance in transfer pricing regime. Chapter 2 basically is the definitive section. It provides definition regarding various terms in the directive. Other terms have been verbatim copied by the directive, as was in the Income Tax Act. The phrases or the words that can be seen on the screen are the new definitions that have been added. These are the key terms in the directive that has been added, as I said, and the others words or the definitions were verbatim copied from the erstwhile act, the present act 2058 or 2001 AD. The chapter 3 is regarding transfer pricing and arm's length price. This chapter basically deals with the principle of transfer pricing and the arm's length principle, and in brief, in a very short form, it in a figurative way, it deals with the principles of determination of ALP and further elaborates on these principles at a later chapter. The chapter 4, which is the main crux of the directive or the backbone of the directive, is the comparability analysis. The 3 steps in comparability analysis, mainly the transactional analysis method, the transactional analysis, functional analysis, and comparability analysis have been spelled out in the chapter 4. Moreover, the steps in the comparability analysis have been put in detail in the directives. Due to the paucity of time and the space given to me, I'm unable to delve into the details of each and every point, but the 6 points that have been mentioned in the directives are the analysis of economically significant characteristics of the business and transaction, examination of comparability factor and control transaction, selection of tested party, identification and selection of comparables, appropriate adjustment to comparables, and selection of the appropriate arm length method. Section 5 is the method of arm length price determination. As our previous speakers have spoken about, these 5 methods are accepted worldwide and also in the UN and the OECD manuals and the regulations. These 5 methods are comparable uncontrolled price method, resale price method, cost plus method, transactional net margin method, and transactional profit split method. So the issue comes if while doing the comparability analysis, if we get more than one comparables, then what to do? The directives guides that the 2 methods that can be used if we have multiple comparables are the median range method and average method. If the data sets are more or equal to 7, then the median range is to be followed. And if the data sets are 6 or less than 6, then the average method is to be followed. And the tolerable limit or the error is 5%. And while following the median method, the 35th and 65th percentile method has been chosen. The arm length falls within these two, 35 to 65th percentile. I'll not go into the details of the calculation in median method and the average method. That can be, I think, be later visited after I share the slides to the ICAN. I'll move into the chapter 6. That is the requirement of maintenance of transfer pricing documentation. Chapter 6 tells that the entities that have transaction of 100 million rupees or approximately 740 USD at current forex terms need to maintain transfer pricing documentation as mentioned in Annex 1 of the directive. Moreover, so that the data and the information submitted to tax office is accurate and verified, a certification or an attestation requirement is has been placed if the transaction or the offshore transaction is of the value 500 rupees or more, that is approximately 3.7 million USD at current value terms. So the documentation that has to be kept as per Annex 1 are in basically 3 points. That is the documentation regarding information of the entities, documentation relating to offshore transaction between associated enterprises, and document regarding determination of price as per ALP. If we revisit our previous speakers, there were requirements regarding master file, local file, and country by country reporting. No such requirement have been specified in this current directive. We hope that this will be amended at a later time when the need arises by IRD. And the final chapter is the transfer pricing administration. What this directive has done is that it has not introduced new sections regarding amendment, assessment, serving of the notice, penalty levied for not filing of documentation or filing of wrong documentation. What it has done is that it has incorporated the transfer pricing regime within the ambit of the current Income Tax Act. So the provisions that were applicable for the filing of the tax returns at the present time has been equally applied for transfer pricing regime. So no new provisions or sections have been introduced in that front. So these are the chapters that the directives have introduced. Now I will put 3 concluding remarks on my presentation, and I would devote 3 slides only for my concluding remarks. That is the preparation for tax authorities. Transfer pricing regime is a new terrain for tax authorities in Nepal as well. So the first and foremost task would be in identifying the number and the type of MNCs operating in Nepal, and at the same time identifying the transfer pricing risks involved. Because there are no prior experiences regarding transfer pricing regime to the IRD officers or tax office, and also due to the scarcity of resources, identifying and maintaining database of comparable transactions would be challenging. So the IRD should assess the current gaps and current capabilities regarding this matter, and also a coordination between various government agencies is a must for proper and effective transfer pricing regime in Nepal. Regarding the business community front, TP policies are normally harmonized across the countries, as MNCs are well versed with the experiences of transfer pricing, but are not so abreast with these working. So, and also there is an uncertainty over double taxation risks and the documentation and the compliance requirement to meet the law of the land. So in spite of the head offices of the MNCs having, I'll finish it within a minute. So in spite of the head offices of the local units having experiences in Nepal, at the initial stage, the head offices should handhold regarding the maintenance of documentation, as the local unit would lack the expertise and skills. And also the MNCs must strictly comply with the directive and other best international practices regarding transfer pricing. And this is the last slide of my presentation. So what's lacking in the directive? The elephant in the room that has been hidden is the advanced pricing arrangement. That is an issue that the directive should address in the future. Safe harbor rules are equally important for truly and vibrant TP regime. So these are absent, and the provisions that are absent are the provisions regarding intangibles and marketing intangibles. As in the today's world, intangible assets are the most important assets, and the conspicuous absence of these provisions should be addressed by the tax authorities in the near future. And also the draftsmanship of the current derivative is also an issue because it is an hotspot of examples, principles, and substantive provisions rather than a bare act that can be seen in drafting other acts. So I think these are the issues that the tax authorities should address in the future as the time comes. ICAN and we as the practicing chartered accountants would definitely help IRD in solving these issues. And with this, I would like to say thank you and end my presentation here. Thank you, Gauravji.
Thank you, Salinder sir. Thank you very much for your presentation. Moving ahead, we now have representative nominated by the Institute of Chartered Accountants of Pakistan, ICAP, Mr. Mohammad Raza. Mr. Mohammad Raza is a partner in Taxation Services Department of AF Ferguson and Company. He has extensive post-qualification experience of around 23 years in tax consultancy, advisory, and appellate services to various national and multinational clients, including representations before the Appellate Tribunal, the Federal Board of Revenue, the Board of Investment, and the Securities and Exchange Commission of Pakistan. Mr. Raza is a fellow member of ICAP, an associate member of ICAEW, an international tax affiliate of Chartered Institute of Taxation UK, and a certificate holder in the subjects of international taxation and transfer pricing from Chartered Institute of Taxation UK. He will be sharing his experience about TP legislation and practices in Pakistan. Now I'd like to hand over the floor to Mr. Mohammed sir for his presentation. Over to you, sir.
Thank you, Gaurav. I hope I am audible and my presentation is visible too.
Yes, sir.
Okay. Thank you very much for giving me this opportunity to share my experience and on the subject. I'll be try to be very brief because I'll try to cover this within the allocated time. In the first section, I'll just try to briefly give an overview of the income tax legislative history in Pakistan because that need to be understood in the proper context so that one can understand how the transfer pricing legislation of Pakistan fits into that income tax legislative history. As you all know, Pakistan was formed in 1947, and just like its neighboring country, it inherited the Pre-Partition Income Tax Act 1922, which was a colonial law. Then this was replaced in 1979 by a new ordinance, which was not very much different from the 1922 Act in principle, because both these laws had a concept of assessment whereby an income tax return filed by the taxpayer is subject to a detailed scrutiny by the tax authorities, and whatever income they assess, that is considered to be his final tax liability. The important thing is that in 1990s, Pakistan introduced a very interesting concept within income tax, which was called a presumptive or final tax regime, which was initially introduced for certain business segments such as commercial importers, distributors, exporters, so on and so forth, whereby their tax incidence was based on gross receipts, or in the case of commercial importers, it was based on import value of goods, and whatever tax was deducted or collected at the transactional basis, that was considered to be a final discharge of tax liability. How this fit into the transfer pricing, I'll try to cover it in the subsequent slides. But what happened was that this 1979 ordinance received a lot of criticism from international donors, and perhaps because in early 2000 Pakistan was looking to attract a lot of foreign direct investment in Pakistan due to different geopolitical reasons. So I think there was a pressure from international community that the tax laws and various other laws at that time, they required some revision to bring them in line with the international standards. Accordingly, the government of Pakistan introduced a new income tax law, which was named as Income Tax Ordinance 2001. And at that time, an Australian legal expert drafted this legislation. And if you would ever see the law, it was adopted in line with the certain international terminologies. And it was quite a modern piece of legislation, at least at that time. And in order to implement the law, the Federal Board of Revenue, which is the apex authority in Pakistan to administer income tax and other federal taxes, they introduced income tax rules in 2002, which govern certain procedural aspects of this law. And both, obviously, just like other developing economies, both these ordinance and rules have been amended from time to time. And the major shift in 2001 ordinance was the adoption of a universal self-assessment scheme, whereby I think this is the norm in many other countries, that whatever return or declaration is filed by the taxpayer, that is accepted for the purpose of assessment. So there is no formal procedure of scrutiny in Pakistan as per law. The income tax returns filed are deemed to be accepted, and those can be amended or subject to detailed audit, subject to certain conditions and limitations. If the tax authorities find out in that process that the treatment of certain taxable income or other matters are not in accordance with the law, they can make certain adjustments. And the concept of FTR, which I just covered in the previous slides, that was kind of abolished in 2019, and now it is abolished for almost all sectors, and it has been converted into a minimum tax regime.
Mohammed sir, sorry to interrupt you, but just to let you know that you are still on the first slide itself.
Oh, sorry. I think somehow the slides are not changing probably.
Yeah, it's
Is it
changing now, sir.
okay? So I just wanted to add that in case of tax controversies, there is a four-stage appellate process that you go to the Commissioner Appeals, Appellate Tribunal, High Court, and Supreme Court. There is an alternate dispute resolution mechanism as well. Advanced ruling concept is also there, but that is only applicable for non-resident taxpayers. And Pakistan has a very extensive double tax treaty network with 68 countries, out of which I think 30 double tax treaties stand modified by a multilateral instrument. Now, coming to the transfer pricing legislation, how it evolved in Pakistan, as you may recall that the earlier piece of legislation of tax in Pakistan was 1979 ordinance. Within 1979 ordinance, which was applicable up to 2002, there was a section 79 which is reproduced here. I don't need to go into that, but if you will compare the language of this section with the Article 9 of various model tax treaties, this is kind of a replica of those provisions. But incidentally, there were no guidance or rules within the law or in terms of any administrative instructions as to how this provision should be practically applied to a particular situation, and therefore certain controversies arose in the context of this provision, whereby certain adjustments were made to the taxpayer's income, and finally one of the matter was resolved by Supreme Court of Pakistan in 2017 in a case. I'll briefly touch upon that case in the subsequent slides. When 2001 ordinance was introduced, as I mentioned, it was drafted by an Australian draftsman, and he tried to adopt a lot of international concepts. So he drafted a provision which was called Section 108, which was placed under the chapter of anti-avoidance, and that basically allows the commissioner or the tax authorities to distribute, apportion, or allocate income and other items between associates. There is a separate definition of associates, so as to reflect the income that the person would have realized in an arm's length transaction. So the concept of arm's length, which is an international concept in transfer pricing, that was embedded by way of this provision. And if you look at the language, this looks like very similar to the IRS section 482 of US code. So the language was slightly changed, but obviously the concept remains the same, that it dealt with the transactions between associates. So this provision remained in this form up to June 2016. And in 2016 and as well as 2018, certain major amendments were made in this provision, whereby if you will look into these provisions, the law added some mandatory requirements of maintaining the documents. When these provisions were initially introduced, there was no mandatory requirement as to how or whether the tax payer is required to maintain any documentation, nor he was required to file any documents with the return. So in this way, the law introduced certain mandatory requirements in the form of master file, local file, and other documentation requirements in respect of their transactions with associates. But at the same time, if you look at the provisions, the concept is that the taxpayer is not required to mandatorily file these statements with the return. Rather, the commissioner may ask the taxpayer that if he wants, he can ask for these details, and once he would ask, the taxpayer has to furnish it within a prescribed time. Then in recently, just this year, in the federal budget, this new provision has been added, which relates to this marketing intangibles, and it seems to be something adopted from Indian experience relating to marketing intangibles, that they say that if a local company or a local taxpayer of a group company is incurring certain expenses which indirectly adds to the value of offshore intangibles, then their marketing expenses can be disallowed subject to certain conditions and limitations. This provision has recently been introduced, so we have yet to see how it will be practically implemented. Then there is a concept of associate, which I would not go into detail, but more or less this is a concept which is applicable under other international regulations as well. But the interesting thing is that the main definition is very wide, which says that any relationship between the two persons is such that one may reasonably be expected to act in accordance with the intentions of the. I have not yet seen the practical implementation of this generic provision, because generally the tax authorities go by the more concrete tests, like 50% or more of certain rights which one party can exercise over the other. Then in the meanwhile, what happened was that in income tax rules, certain chapters were added to cater for the amendments of documentation, and first time penalty provisions were added in 2017. So before 2017, there was no penalty provisions, that if somebody does not maintain the documentation requirements, what can happen with him. So they specifically introduced penalty provisions, perhaps to make it mandatory for the taxpayers to adopt those documentation requirements. A new concept of a directorate of international taxes or transfer pricing was introduced, which apparently was aimed to provide a separate tax office to deal with such situations, but to date it has not yet been implemented. So this is only part of our law but not practically implemented. Then in 2019 they also allowed the commissioner, they are probably, the legislature is probably conscious of the fact that tax authorities are not expert in these cases, so they allowed them that they can consult an independent chartered accountant or cost and management accountant to determine the arm's length value of any related party transaction. But again, I'm not aware of this provision having been applied in any of the cases. With regard to arm's length rules, there are certain rules in income tax rules 2002, but interestingly, these were introduced in 2002, and no change has been made whatsoever since 2002. And if you will look into those rules, they only provided four methods, cup, resale price method, cost plus method, profit split method. And in terms of these rules, there is a specific rule which says that the preference of traditional methods has to be given over profit split method. You all are aware that this was a concept under the old OECD international transfer pricing regulations, which were perhaps prevalent at the time when these rules were drafted. Later on, a lot of amendments have been made, but these rules have not yet been updated to reflect how the international landscape has changed. Then there are rules to prescribe that what is the master file. This is again in line with the international prescribed methodology, that what should be in the master file. The only thing is that this is applicable for those taxpayers who are a constituent entity of an M&E group, and for that the total consolidated group revenue of euro 750 million or having a turnover of more than PKR local rupee 100 million has been prescribed. Local file requirements are also in line with the international regulations, and this is the kind of reproduction of the rules whereby it is mentioned that what should be mentioned in the local file. The important thing is that the requirement applies on a taxpayer for all transactions with associates which exceed local Pakistani rupee 50 million. So it's a kind of a safe harbor rule that if transactions are below that limit, you are not required to maintain a local file. Then CBCR concept was introduced. Again, this was part of the international initiative of base erosion and profit shifting. So country by country reporting requirement is also applicable in line with international rules. Then there are certain specific provisions relating to financial transactions. We do have a thin capitalization rule since very inception of 2001 ordinance, whereby foreign debt to foreign equity ratio is prescribed as to 3:1. So if the ratio goes beyond 3:1, no matter whether interest is charged on an arm's length basis, the interest relating to the excess ratio is disallowed. And another provision was added in 2020, whereby they said that in case of related party loan, if the interest amount exceeds the total income beyond 15%, then the excess is disallowed. I think that was probably aimed to discourage that if there is a related party interest which is causing a lot of reduction in the taxable income, then that should be disallowed. Now, just briefly, there have not been a lot of transfer pricing controversies in Pakistan, but the ones which I am aware and which are in public domain, I'll try to briefly touch upon. The first and foremost, I think the maximum disputes which have arisen so far were in relation to pharma sector, because in Pakistan, pharma sector was at one time dominated by multinationals, and there were a lot of transactions where the question arose that the raw material imports by them from the related parties are not on an arm's length basis. And this matter was decided by Supreme Court of Pakistan in a judgment which was given in 2017, interesting, that related to a dispute which originally belonged to 1991 or probably late 80s. But the Supreme Court tried to reinforce that transfer pricing is an international subject. Therefore, tax authorities should follow the international guidelines and the methods which are prescribed by the international tax forums. And they also emphasize that the burden or onus of proof lies on the department. They have to come up with the proof that because of this transaction or because of the pricing of this transaction, the taxpayer in Pakistan has caused the loss of tax to the government. So the burden of proof principle was enunciated in a very explicit manner. Then there are certain controversies which are right now sub judice in different forums. One is a related party foreign currency loan, where a taxpayer got a loan from his foreign associate, and tax authorities, relying on a secret comparable, they thought that the interest has been not charged on an arm's length basis. Then there is a case of a non-resident who there's a case of an MNC which imported certain machines from a related party, whereas another competitor was importing the same kind of machines from an unrelated party at a lower value. So over there, the matter is sub judice in appeals. Then there is a particular issue relating to a tea company, where again the tea imported price is being compared with the import price of a tea in an unrelated transaction, and the matter is again sub judice in appeals. And in another case, intra-group services are also being subjected to the scrutiny. But if you will look into the quantum of our disputes, the major reason why many disputes did not arose during last, I think, almost 20, 30 years was this final tax regime concept, which I slightly touched upon in the initial slides, because many multinationals then felt that since final tax regime was presuming that if you will pay tax on import value, you will not be asked to pay any further tax. So many of the MNCs actually changed their business model to commercial importers rather than a manufacturing model. So this is one of the reasons why there have not been a lot of disputes in the past. This is my personal view. Now, just this is the last slide, that what are the challenges which we are facing in Pakistan. Those are very similar to the challenges highlighted by my other fellow speakers from other countries. That in Pakistan, as I mentioned, the local transfer pricing rules, particularly on preference of methods, are not in line with OECD International TP guidelines. So whenever an MNC is handling that transaction, they expect that whatever rules are there in the OECD or other countries, those will be aligned with Pakistan. So this is one problem which needs to be addressed by the government. Then there is no advanced pricing arrangement mechanism available in Pakistan, so that causes a lot of uncertainty. Then there are no available transfer pricing databases, neither to the taxpayers nor even to the tax authorities. Hence, most of the actions which tax authorities take are based on secret comparables or based on customs data, which is always subject to a lot of legal arguments when it goes to the appeals. Then transfer pricing is a very specialized subject, and it needs to be handled by the tax officer, who should be properly trained for this purpose. Right now, transfer pricing can be picked up by any normal assessing officer who may not be as trained as it should be. So this is where the problem arises. Then lastly, there is no experience on mutual agreement procedure, nor there is an enabling provision, because obviously in the cross-border transaction, there is always a risk of economic double taxation. which needs to be handled in a very appropriate and delicate manner. So this is all from my side, and thank you very much for the time given to me. And I'm sorry if I've crossed the threshold of time given to me. Thank you.
Thank you very much, Mohammed sir, for your presentation. At last but not the least, for experience sharing, we have representative nominated by the Institute of Chartered Accountants of Sri Lanka, CS Sri Lanka, Ms. Sadmaine Tilakaratne. Apologies if I pronounce your name incorrectly, ma'am. Ms. Tilakaratne is a partner and tax leader providing tax solutions to a multitude of domestic and international clients. She has experience of more than 18 years in the field of taxation, both in professional services firms and the mercantile sector. She has knowledge and expertise in direct and indirect taxation relating to all industries. She has worked with the regulator and GOSL in the formulation of tax regulations and tax policies, and is frequently invited as resource person at various forums, including educational establishments. She will be sharing her experience about TP legislation and practices in Sri Lanka. Now, I'd like to hand over the floor to Tilakaratne ma'am for her presentation. Over to you, ma'am. Ma'am, are you there? Okay, ma'am, we are looking into the issues regarding your mute and unmute. I think you are audible now, ma'am. I think your sound is not audible. Everything appears fine from our side, ma'am, but still you are not audible. So Tilakaratne ma'am is joining us soon. You are still not audible, ma'am.
Can you hear me now?
Yeah, you are
Yeah,
audible now. That's a great.
Great. Okay. Thank you. All right. Can you see my screen?
Yeah, we can, ma'am.
Okay, great. So good evening, everyone. I'm sorry about the small technical difficulty we had. I'll try to catch up my lost time. I'll take you through the Sri Lanka transfer pricing regulations. So just to give you a brief history of the transfer pricing legislation in Sri Lanka, we started transfer pricing in 2006. But although it seems as if we've started almost as close as India, it was really just one basic section in the act which just said, transactions between associated enterprises should be at arm's length price. But there was no real definition or regulations issued around it in 2006. So mostly in 2006, it was just sort of a cosmetic provision. However, in 2013 and between 2013 and 2016, more detailed regulations were incorporated and issued. And here we saw a distinction between international transactions and domestic transactions, which was previously not available under 2006. We also saw the introduction of the regulations of approved accountant certificate for related party transactions, which had to be submitted as a compliance rule. And we saw the format of this approved accountant certificate also being issued in 2015 to 2016. So in fact, transfer pricing regulation started being a compliance requirement around about 2015, although it was first introduced in 2006. Thereafter, in 2018, there was an introduction of a new Inland Revenue Act in Sri Lanka. The old acts were repealed and a new act was introduced. And in this act, more detailed sections on transfer pricing and related regulations were introduced. And under this act, and this is the one, and under this act and under these sections and under these regulations are what are now prevalent and what we use currently in Sri Lanka, and around which the compliance requirements rotate. So in 2018, this was introduced. 2021, we saw some small changes, but essentially the detailed regulations were issued in 2018. So let's take a look at what are these regulations and the transfer pricing law around Sri Lanka. So more or less, Sri Lanka also follows the OECD principles. A lot of what was mentioned by my previous speakers apply to Sri Lanka as well. So we have the arm's length price, which is a price between unrelated parties in uncontrolled conditions, which is the arm's length price. The concept of associated enterprises is defined. Again, it's where one entity participates directly or indirectly through one or more intermediaries in controlled or in a controlled transaction, the second mentioned enterprise. Now, this is supplemented by 11 clauses, which again was detailed by my previous speakers, and I'll take you through it if I have some time. It's more or less the same, but perhaps what changes in the 11 clauses are the respective percentages. In 2018, it's pertinent to note that it specifically mentioned that an associated enterprise includes permanent establishments. Now, under the current regulations, the covered transactions are as follows. We have two types, international and domestic. International transaction, that is where it is between two or more associated enterprises, either one or both of whom are non-residents. This also includes deemed international transactions. So the concept of deemed international transactions has been prevalent in our law since 2018. Domestic transfer pricing is also applicable if one of the following conditions are satisfied. So that is where transactions between two associated enterprises domestically will be subject to transfer pricing rules if one of the entities are tax exempt, or if one of the entities enjoy a differential tax rate to that of the standard tax rate. So let's say if it's at a concessionary rate, or if one of the entities are currently incurring a loss or incurred a loss in the previous year of assessment. So why is that? Because domestic transactions would only, or there is a potential for there to be a tax leakage in case of a domestic transaction only if there are one of these three things happening. Otherwise, there's really no shifting of tax, no shifting of profits, because it's within the country and there is no tax leakage. It's only if one of the three conditions are prevalent that we will have transfer pricing applicable to domestic transactions. Then the transfer pricing methods we use are essentially the 5 methods which are prescribed even under the OECD regulations. So we have the traditional method, which is the CUP and the RPM and the CPM cost plus method. And of course, we have the transactional method, which is the profit split method, and the transactional net margin method. There is no preference on selection of the most appropriate method. There is no prescribed preference. It is up to us to use the most appropriate method out of the 5 methods. We have the comparability analysis under a range concept, the interquartile range. We use the 25th to the 75th percentile. This actually again was introduced in 2018. Previously, we used to be under a mean arm's length prices calculated under a mean basis with a plus or minus 3% leeway, but now we have moved to the interquartile range again in line with the OECD principles. There is no specific regulations on the use of multiple year data. We do, however, have to update our comparables every 3 years. However, or conduct a fresh benchmark every 3 years. However, the financial data of comparable companies have to be updated annually. Documentation is also prescribed under the Sri Lanka regulations, and we have a 3-tier documentation. So we have the local file, master file, and the CBCR in line with the OECD guidelines again. We also have to file a transfer pricing disclosure form along with the annual corporate income tax return, which is due on 30th November of each year. Now, I mentioned previously that under the old regulations, which were introduced in 2013, we had the concept of the approved accountant's certificate, where it had to be signed off by an approved accountant certificate. But with the introduction of the fresh regulations in 2018, the concept of the approved accountant was taken off, and there is no requirement anymore for an approved accountant to sign off the disclosure form. But nevertheless, the TP disclosure form has to be filed as part and parcel of the annual corporate income tax return. We also have to file the local and master file, and it has to be submitted on request within 60 days, on request by the Department of Inland Revenue within 60 days. So this is the 11 supplementary clauses I spoke of earlier on how to determine associated enterprises. As you can see, we have that equity and debt concept, the management, activities, and control. So if you see that these are more or less the same as what was described by my previous speakers, except that in the percentages may differ. So in case of equity, the majority of the voting power, it has to be more than 50%. Loan more than 51%, but the guarantee is 25%. So appointment of board or directors also, if more than 50% is appointed by one entity over the associated enterprise, then that is also deemed to be an associated enterprise. Activities where more than 90% of the raw material on the influence price, all that is similar to the previous regulations that were spoken of by my previous speakers. We also have the catch-all clause, which is control transaction differs from transactions that would make or improve by a person not participating in the management, but confers a potential advantage to the enterprise. So this is sort of the catch-all clause, which doesn't fall under this. But if you have a transaction which potentially confers an advantage of the enterprise over to the other enterprise, then that also can be considered as an associated enterprise. This is only required if you have an aggregate control transaction value of more than 200 million Lankan rupees. Okay, so this is the only time it becomes mandatory to comply with the local file and the TP disclosure form. And as mentioned previously, it has to be provided, the local file has to be provided within 60 days of written request by the Commissioner General of Inland Revenue. But the TP disclosure form has to be filed annually with the corporate income tax return on or before 30th November. The failure to do so would mean that you have filed an incomplete income tax return. A master file is applicable where you have a group revenue of more than 50 million euros or equivalent in Lankan rupees. Again, these are same as the OECD guidelines. Here too, there is a 60-day window that is given for you to provide the master file should the Commissioner General of Inland Revenue require it. Country by country report is mandatory if the group consolidated revenue is more than 750 million euros, similar to the OECD. It has to be filed on or before 12 months after the last day of the reporting fiscal year of the multinational group. There's a notification that has to be filed before 31st of the year of assessment. So if it is applicable for you, there's a notification that needs to be filed, and then the CBCR. So as I mentioned, it's all in line with the OECD BEPS action plan. We also have certain penalties that have been introduced, or rather stringent penalties that were introduced from to
Ma'am, your screen got freezed. So you are not audible now.
Seems she's offline.
We are not able to hear you, ma'am. Ma'am, are you there? We are not able to listen to you.
So Gauravji, I think she is offline. So can we proceed forward with the remaining presentations?
Okay, sir, we will proceed ahead. Due to some disturbances, we are unable to complete the presentation of Tilakaratne ma'am. But nevertheless, with the presentation, we have come to the conclusion of first technical session of this webinar. Thank you to distinguished dignitaries for delivering insightful presentation and providing us major takeaways on TP legislation and practices in your respective countries in such a limited span of time. Your expertise and wisdom have truly enriched our understanding, and we are sincerely grateful for the opportunity to have attended. In the third session, which is the question and answer session, we will be putting forward some queries or questions to the speakers of our session 2. So we kindly request our esteemed speakers to be with us throughout this webinar. Now we move to second technical session. In the second technical session, we have a very important presentation on transfer pricing database for SAARC countries, the challenges and way forward, from Mr. Manonit Talal. Mr. Manonit Talal is a founding director of Hexa Advisors Limited, a consulting and technology firm focused on building technology solutions for global transfer pricing practice. Over the past 2 decades, Mr. Manonit has worked at multiple levels in Big Four accounting firms, wherein he gained valuable experience on all aspects of international tax and transfer pricing. He has also argued international tax and transfer pricing cases before tribunal and courts. He has more than 100 reported cases to his credit. Mr. Manonit assisted various multinational clients with transfer pricing engagements involving planning, documentation, and compliance. Before I hand over the floor to Manonit sir for his presentation, I'd like to kindly request him that he will be allocated around 20 to 25 minutes time for his presentation. So you are kindly requested to plan and deliver your presentation accordingly. Now I'd like to hand over the floor to Manonit sir for his presentation. Over to you, sir.
Thanks, Gaurav. I'll try to keep it short, not an issue. Okay, just wait, just 1 second. Okay, I just will need to, I think this, I'll just log in again, just a second, because there has been some, it will quit and open, okay. Hello, I'm audible now?
Yes, sir, you are audible.
Yes, and my screen also should be visible.
Yeah, it's visible, sir. Yeah, your PPT is visible, sir.
Right. So thanks everyone, and thanks everyone for quite insights into respective jurisdictions, how the things are going. So the key challenge that we all face with the transfer pricing is transfer pricing database, because what we are trying to do in transfer pricing is trying to find a most appropriate comparables. Finding appropriate comparables and benchmarking is the key for any transfer pricing analysis, because the burden is on our taxpayer, right? That he needs to find the right appropriate comparable for benchmarking. That is, so virtually I will be covering just quickly 4 sections here. Transfer pricing and the use of database, various sources of databases, challenges which we face, and the way forward. Sorry. So if I really talk about a business process analysis and framework, the way we actually require transfer pricing database is for multiple level. We call it either industry analysis, company analysis, basic design, process analysis, contribution analysis, if we do a detailed transfer pricing design and implementation level. For the purpose of this presentation, because we are talking about very basics about transfer pricing, I have restricted the presentation to transfer pricing documentation, which is transfer pricing report. And in transfer pricing report, it's primarily into 5 sections, as we all are well aware of. We generally talk about the background, and based on the profile background of the company and the group, we write industry profile, and then we do a transaction analysis. And on the transaction analysis, we do a function analysis, and based on a functional analysis, transaction analysis, we do economic analysis. The idea of to put these 2 things is the 2 things which primarily go into report is industry analysis and economic analysis. Why I'm putting it here is because most of the time people think is economic analysis is only where the transfer pricing benchmarkings are getting used. But it's actually is the two places where analysis of a transfer comparable or the industry analysis goes into. One is at a macro level, which is industry analysis. Second is at a transaction level, which is economic analysis. And these both things need to sync in a proper transfer pricing report. So in the industry analysis, generally, we should generally talk about the group businesses, key profit drives, competitive landscape, directly and indirectly trends which are impacting the industry. So for example, if COVID is impacting industry in a particular mindset, then we used to capture everything in the industry analysis. And then that becomes a base for doing those kind of adjustments and analysis in a economic or benchmarking analysis, where we do find comparables, financial metrics, global coverage, and the support for transfer pricing documentation. So those things all are done. So economic analysis and industry analysis needs to be completely aligned. So you can't say in one analysis, for example, if I'm doing a benchmarking for Bangladesh, if I'm saying textile industry is booming in Bangladesh, then my economic analysis should also show that. If there is certain factors that need to be adjusted for Sri Lanka, then it needs to be adjusted in the industry analysis also. So why I'm saying that, because we are a company which we do database and the searches for the entire region. So we have been doing transfer pricing benchmarking for Bangladesh, Sri Lanka, India, and for Southeast Asia and Middle East also. That's why we are fairly aware what all is going on in the region also. Then we come to the types and the sources of the data. There are generally two approaches which are generally being used when we go for a data. We need to understand these two approaches first before we take how we are actually going to find a comparables. One is a deductive approach and second is an additive approach. Deductive approach is generally where you find a particular database and then you exclude from a broad set, you take objective steps, adopt one by one objective steps, and then you reach comparable companies. The best way to look at is, so from say 10,000, 5,000, we actually reduce to 20 comparables. This is more a kind of a penalty avoidance kind of approach, which generally most of the time is done, because the objective of this approach is just to highlight that purpose of transfer pricing is that since there is a burden which is being costed upon a taxpayer, so he is did a search based on the available databases, and on that, whatever the restrictive comparables he is able to get, he actually has chosen those kind of comparables. That is a primary purpose of the deductive approach. This is a fairly common approach, or I will say 99% of the transfer pricing report, if we really see in the region, is actually done in that particular process itself, which is a deductive approach. Additive approach is a fairly uncommon approach. It's used for complex transactions where we actually try to find a right comparable, and we just keep on adding if we are not finding more or less comparables. This approach is picking up very recently, primarily because of a good databases nowadays, or what you say, AI's driven databases, or what you can even call a ChatGPT or Gemini. They can actually help you create a kind of addictive kind of approaches. So these are good things that is actually happening with the addictive approaches. But this is fairly new for the practice. If I just really have a quick glance of what is kind of data is available in the region, right? If you really see, my slide is actually clearly talks about in the region itself. If I talk about Bangladesh, we have only around 600 plus companies, listed companies for which data is available. Bhutan is fairly low. India, we have 6,000 plus, but the good point is in India, listed companies are also, private limited companies are also for data is available for a payment of fees. And there are good developed databases also, which I will be talking about in my subsequent slides. Maldives, we are fairly, is almost negligible. Same goes for Nepal. Roughly, we have 200 plus companies in the Nepal. Pakistan goes for around 540 companies. And Sri Lanka also, we have limited number of companies for the data is available. So the reason of mentioning all this, because being a database company, we actually keeps on looking for solutions. Me and my entire team, we are into transfer pricing for almost 2 decades now. So we are looking for how can we actually help this basic issue of finding a right database. So quickly about regulations, this we have all discussed. I think all of my friends have really shared quite a kind of a their status about the regulations, and they have also shared about their database availability issue also. As I mentioned, India still have some good relevant databases which captures a good amount of data for the region. Bangladesh, we have a very limited data, so there is a preference to use Bangladesh either India databases or a regional databases, especially more towards the Asia Pac region, which is getting used in Bangladesh. Same Pakistan, frankly, we have not worked. Sri Lanka is also a similar kind of preference because companies which are working in either Bangladesh, Sri Lanka, or Asia Pacific companies, so they are open for out about Asia Pacific comparables as well as India-based databases. Nepal is pretty new, so I think how the time will test, and there is not much work in Bhutan and Maldives. So one is obviously deductive approach, as I mentioned in my earlier process also. It's actually where we go on a broad database set, and from that broad database set, a number of comparables are being chosen and many filters are being applied to find a kind of a right comparables. So it's a deductive approach. So first is a quantitative kind of filters are applied. And when I say quantitative filters, it's like a statistical filters. It's a use of stats filters to remove all the companies which are not cannot be analyzed because of lack of availability of data. It can anything. It can be insufficient financial information, no operations, say companies or small size of a company. Then there is a little bit of qualitative kind of analysis that is generally being done, which is on the basis of a comparable product or function. When I say comparable product, it generally goes for a manufacturing company or a trading company where the more product comparability is worked around. Comparable function is where the companies are getting rejected if the companies, for example, into manufacturing, the product or services company will trading or services company will get rejected on the function part. Second, which is a more fluid filter, is related party transactions. It depends upon transactions to transaction and from country to country. And then there are certain abnormal parameters where the apart from tolerance zone or the range of 35 to 65 or 30 to 70 for Bangladesh, right? So the issue is to remove the companies which are even abnormally behaving in a particular year. So those are also a qualitative kind of filter that is being applied. So applying these kind of filters, a deductive approach based on data sets, it is, so these approaches are irrespective of all the databases. This has established over the last couple of years and are well accepted by the tax authorities also, because when they need to find comparables, they need to also find comparables from a respective data sets only. So when I talk about transactional data, there are three kind of transactional data that are generally, I think I'll take the second one first. So when you talk about databases, in India, we have primary 4 databases. One is Prowess, which is done by Center for Monitoring of Indian Economics. They have roughly around 35 to 40,000 of relevant year data. So this is fairly popular in India, even with the tax authorities. Second is Capital Line. So the price of Probus is around 2.35 lakhs INR. Capline is also one of the most prominent database. This is primarily being used by most of the tax authorities. This is the second database which got developed in India around 2006-7 onwards, post transfer pricing got introduced. So this also database got really good established market, especially with the tax authorities also. So this database has around 15 to 20,000 relevant year financials. Then is ACE database, which also gives you good comparable companies, around 10 to 15,000 companies. Prowess is something which is accepted by authorities in Bangladesh as well as in Sri Lanka. So they have good acceptability in our region per se. Then there is a database Hexonomy that we have been working on, that is we have developed, which comprises of around 1 lakh companies from India and all the above listed companies which have shown you from the region that we have actually included to make it a complete SAARC region-based database. For the foreign databases, there are a couple of other databases. One is Compustat, This is primarily being used in US. And if you are working for a US entity, CompuStat is one of the database that is being used primarily there. Then is Amadeus. Amadeus is Orbis or TP Catalyst. It has multiple formats through which it is being known. So they have actually a search-based formats also, CompuStat, Amadeus, which is TP Catalyst, which is commonly being used, though it's little expensive, around $1,500 to $2,000 based on the subscription that you have taken. Then is Thomson. That is also a kind of a database which gives you a Thomson give you more data about the developed countries. So it has a good data for developed countries or Southeast Asia region, but very less. So all these three foreign databases have very good limited database about the SAARC region, if I'm really talking about a region. So if you have European head office or US head office or even Australia, so or Southeast Asia, then these are the databases are at least well accepted. So the Big Four also uses all these three databases, Amadeus and Thomson primary for their global searches. And then is Taxonomy, as I mentioned. So we also have a global database also where we have more than 1 crore companies, which overall covers all the entire globe. So now come to the database from more from a transactional purposes. So there are certain things which can be we can find data from commodities market or the exchanges also. Something like if we have to benchmark say metals or the minerals or oil and gas. So those are, you can find it at various prices or exchanges, commodity exchange prices. So those can be well utilized for the purpose of benchmarking. Interest is also one of them, but interest generally comes under the financial transaction, because unless there is a plus kind of markup, so those base bank rates you will get on the commodity exchange bank to bank rates, but you will not get the markups. So next is the most common thing is for the intangibles is the royalty transactions. There is a two common databases primarily work on that. One is a royalty state and a royalty range. Even Google will give you good results. Even we have developed on the same based on royalty, because so SEC companies which are registered in primary 3 stock exchanges, which is US as well as London Stock Exchange and the Hong Kong Stock Exchange. So they are required to give their agreements. So all this royalty stat, royalty range, and us, we collect information from these stock exchanges, and we segregate the agreements to make it a proper royalty agreement. Or you can find a commission agreements there or service specific agreements. If you want to do a journal search, you can do all these searches on the Google also, because since SEC on all these certain stock exchanges are open searches, so Google also has certain links. So if a proper search is done on Google, you can actually find certain agreements on the Google itself. So you can, if you are doing some limited search, you can actually avoid spending that kind of cost also. Then is obviously financial transaction. This is a little tricky because most of the time, though all listed companies give detailed information about their financial transactions, but yes, consolidating them, putting them together is most of the time takes these databases, and this financial database is generally is a benchmark for their credit risk calculation, etc., which are very important for doing any kind of a financial benchmarking. So for that, a proper database needs to be worked upon. So Thomson Reuters, they have Reformative, which is called loan corrector, that is well recognized in the entire region. It's most preferred in the region. Then is Bloomberg, which is randomly used because of its a very high pricing. Moody Risk Calculator is also one of the database being used. And then definitely we also have developed our own database on this. So the challenges with the transfer pricing database, as we have all seen, is obviously limited availability of the comparable data. Database often, as we say, lack comparable companies. And if so, the challenges that we face is one is description information. So the companies which are there available, even for which the financials are available, they don't have enough business descriptions available. But the good part is in last 3-4 years, the good tools are available in the market. That's frankly is one of the reasons if though many databases are still working upon it and trying to come up to that level. But yes, by the use of those tools and techniques and the many scrappers which data scrappers are available, those information are able to build up in the should be able to build up in the database. We have done that in our database, so we know it should. I think other database should be able to cope up to that level. It's not a very difficult task nowadays. Then is a lack of financial database. Typical provide company level database. So company level database is quite available. India alone has more than 26 lakh companies for which the financial data is available, which can, if we really talk about a geographical region, which can bring down to all the companies in the geographical region. And because most of the companies are transacting with somewhere in the region is with India. So I think this can be along coupled with region, it can be used as one of the database set. Second is, I think more comes about the geographical region, whether we want to use a geographical region specific or regional specific databases or not. It's more depends upon a particular kind of industry for which benchmarking is done. But then obviously transaction level data kind of a transaction level specific data. It's more to do with the financial accounting and which is being prescribed and how it needs to be displayed. So that is one of the limitation that we have, because despite volume of data which is being available in India, the data which is being displayed, for example, for SEC companies in US is not that kind of volume of data is being there in India also. So that is one of the consistency, I think, limitation that we have with regard to the data. So any data inconsistencies, variations in the financial reporting standard across the region becomes one of the issue when we are trying to create any kind of database. This is the biggest issue that we face. Especially when you try to apply it across region, because most of the time you will only find gross margins and how various different accountings are being done. And the more you move from one country to another country, there is a serious issue how the regions and the financial reportings are done. That actually creates a bigger issue of creating a database. And that's what you will find in the databases also. And that's also brings a bigger challenge what needs to be shown as operating and non-operating when we are talking about really transfer pricing purposes, because since we need to compare the exact margins or the exact transactions, so then this inconsistency becomes a major hurdle in any kind of a database. The quality and reliability of data entries in some databases are inconsistent, incomplete, but I do feel, I think those things should be addressed now because there are better OCRs available, and use of multiple OCRs and co-correcting them among themselves is actually can take care of those things. Then is obviously is a cost constraint. Yes, most of the databases they are very, very expensive. I will not say only expensive, it's very, very expensive because no international data starts less than $15,000 or $20,000. For 1 year, and they also comes with the restrictions of how many times you can use that. It's not that even if you buy a royalty stat today for say $8,000, they will only give you 50 plus agreement download. So those are biggest issue. Orbis Amadeus, they actually try to create a TP catalyst, but still they don't allow you to do a search, a single search less than $2,500 or $3,000. And then that's the reason of they are quite expensive. Historical data, and because it might not be very expensive from a European or American standard, but when we try to apply those in obviously in our region, it becomes very expensive. I think that's one of the factor that makes a good market for at least for us. Benchmarking often relies on historical financial data, which not accurately reflects current market conditions. So the problem most of the time that is being faced is Business description and other informations are taken from the website and Google driven searches. And the financial data are more or less there. So those are more updated, and the financial data comes after 1 or 2 years. So there is a mismatch between the relevant information which is there in the market and what is really happening in a particular company and what is data which is getting reflected. So that is one of the major mismatch which is creates a lot of issues. Second, the last one which comes for is obviously adjustment for functional differences. Even for identifying potential comparable, significant adjustments may be required to account for differences in function performed. And generally, not enough data is available for making these kind of adjustments. Only very few limited adjustments like working capital for a trading company or capacity adjustments, if details are available in detail, can be made. Otherwise, many adjustment cannot be made. That is also one of the key issue that most of the time is being faced. The last one is the local database limitations, which we all faced, but I think trying to focus as a SAARC initiative, I think we should also all try to focus about the regional specific database. So way forward, I think since the time is quite limited, I can just skip that, since we, as a company, we are quite working towards it, because we are 6 people who have more than 15-20 years of Big Four experience. And we are primarily on a company which is only for transfer pricing database and which are working. So it's to obviously create a database for the SAARC region. That is our primary goal, and to cover all kind of various kind of issues that we face, either financial transaction or royalty transactions. All those things we want to capture under one umbrella, because otherwise it becomes too expensive. And rather than selling entire database, our focus is to for the entire one. So that's the cost optimization and enhancing local database development. That is our key primary issue. And we are leveraging a lot of technology which is being developed, and that actually really helps in creating those comprehensive database. With all this, I thanks everyone for your patient hearing, and anything else we are open for question. I think you can ask anything related to database and what any issues you face and how we can address that. So with that, over to you, Gaurav. Thank you.
Thank you very much, Manonit sir, for delivering such deep and insightful presentation in such limited time span. Your dedication to sharing your knowledge and insights is highly appreciated. Before we proceed towards the third session, Tilakaratne ma'am has rejoined us again, so she wishes to complete her presentation. So I'd like to request Tilakaratne ma'am to complete her remaining presentation. I'd like to kindly request her to complete it within 5 minutes if possible. Over to you, ma'am.
Sure. Thank you. You can hear me now?
Yeah, ma'am, you are audible.
And you can see my screen, right?
Yes, we can.
Okay. So I believe I stopped previously at the 11 clauses that would constitute a deemed associated enterprise. Just to quickly tell you that the documentation that I mentioned earlier, we have thresholds that are applicable in filing this documentation. The master file and the CBCR are same as the OECD principles. The local file and the DP transfer pricing disclosure form, there's a threshold of 200 million LKR aggregate control transactions. It's only then that you need to file the local file or the TP disclosure form. I'm just quickly moving on. We also have penalty provisions for non-compliant with the transfer pricing regulations. And these are the penalties that have been mentioned. So you have for various categories of non-compliance, non-furnishing of details, incomplete details, and so on. It's fairly straightforward and available in the regulations. We also have an assessment procedure here, and I know this slide looks detailed, but it is, I mean, an assessment procedure which is specific to our country. But the point that I would like to highlight here is that there is a lack of transparency in part of the assessment, in the part of the hearing of the transfer pricing cases, especially where it is referred to the technical review committee and the tax and the the dispute resolution panel. These orders have to be either unanimous and then only would it be a final order. But the taxpayer does not have transparency so as to see whether the decisions were actually unanimous. Because the quorum is not mentioned, what constitutes unanimity is also not mentioned, and the taxpayer is not afforded most often a chance to represent themselves at the technical review committee stage. So there we feel that there is a little bit of a violation or challenge with respect to the principles of natural justice. Then I'll take you quickly through the key challenges or the key issues that are facing transfer pricing legislation in Sri Lanka at the moment. One is that we don't recognize year-end transfer pricing adjustments, even if it is made in the books of accounts. Before the books of accounts are closed. So especially with respect to downward transfer pricing adjustments, the local revenue authorities don't really recognize these TP adjustments and they disallow them. Although this is a practice in line with the OECD principles, these year-end transfer pricing adjustments are not generally accepted in Sri Lanka. We also face certain challenges in the computation of interquartile range. The local revenue authorities use an Excel-based formula to calculate the range, and then there are discrepancies between the 25th and the 75th percentile. And we've made our submissions in this regard, and we hope it will improve as we go along. Intragroup services is a keen hunting ground of the local revenue authorities. They look to see whether we have received the benefit for the amount paid for these intergroup services, whether the taxpayer has actually received the proper value, whether cost-benefit analysis is in place, and taxpayers to demonstrate the type of service that has been received and the value of the service that has been obtained. So in addition, there are also challenges around the recharacterization of financial transactions. So this is actually a low-hanging fruit for the revenue authorities, where they tend to classify long outstanding balances between related parties or associated enterprises as financial assistance. So let's say Sri Lanka has a long outstanding trade receivable from an associated enterprise outside Sri Lanka. If it is outstanding for typically more than a year or so, the revenue authorities tend to classify it as a loan given or financial assistance given and impute an interest income to that, and they request you to make a tax payment on that imputed interest income. They disregard the surrounding environment that has resulted in the outstanding receivable. It can be economic crisis. It can be financial difficulty of the related associated enterprise. They tend, though, to not accept these sort of reasonings that are provided by the taxpayer, and they try to impute some form of interest to these transactions. We also have to do a mandatory copy filing of the CBCR because we have not signed the Multilateral Competent Authority Agreement. And then the last but not least, we don't have alternative dispute resolution mechanisms like the APA, MAP, or Safe Harbor. Currently, the regulations provide for an advanced pricing agreement mechanism plus 7 Safe Harbor rules, but the regulations have not been issued around it. So as of now, we don't have APA agreements. We don't utilize Safe Harbor rules. We have also not used MAP as an alternative dispute resolution. This may be because of the lack of maturity of the transfer pricing regulations in Sri Lanka. And as we move forward, I do believe that they are gathering learnings from other regions and other jurisdictions to try and implement these alternative dispute resolutions. Thank you. I appreciate the additional time given for me to complete my presentation. Most grateful. Thank you.
Thank you. Thank you very much, ma'am, for your presentation. And with this, we now proceed towards the third technical session of this webinar, which is the question and answer session. In this session, C.A. Sarendra Upreti sir will facilitate us as moderator, and our subject matter expert, Dr. Sanjay Kumar sir, will be addressing most of the queries or questions. Talking about Dr. Sanjay Kumar sir, in his more than 35 years of professional career, he has worked in various capacities with government, private sector, academia, and with international organizations. Dr. Sanjay was a tax partner with Deloitte India from 2015 to 2024, where he led Deloitte India's all transfer pricing or corporate tax projects on advanced pricing agreements and mutual agreement procedure for more than 400 domestic and multinational clients and negotiated their complex tax agreements with the government. Before joining Deloitte, he was in the Indian Revenue Service for 28 years, holding many positions. Further, he has been senior fellow and adjunct faculty with the Duke University, USA since 2007 in the Sanford School of Public Policy, where he teaches public finance and revenue forecasting. Moreover, he is an IMF Impanel Tax Administration Assessor. We are honored to have you, sir, in this webinar. Further, Sarendra sir will also put forward questions to the speakers of first and second technical sessions based on the discussions on that sessions. Besides, we will also be covering questions from our participants to the maximum extent possible. The total duration of this session is going to be around 1 hour. So for moving this question and answer session ahead as a moderator, I would like to hand over the floor to CA Sailendra Upriti, sir. Over to you, sir.
Am I audible, Gaurav, sir?
Yes, sir, you are audible.
Thank you, SAFA, for providing me with this opportunity to moderate this session, which is also the main highlight of today's webinar. We have with us Mr. Sanjay Kumar, a name that needs no introduction. Sanjay sir has a distinguished and illustrious career on both sides of the aisle, government as well as the private sector. He also teaches at the prestigious Duke University, USA. Recently, in the month of July, current year, he gave lectures on transfer pricing over 6 days here in Kathmandu, Nepal. These lectures were organized by ICAN, and many of us, including me and my colleagues, attended the program, and we highly benefited from his lectures. So now let me turn to him and ask a few questions. First, let me start with the rationale behind introduction of the TP regulation, why we need those regulation or laws. The second limb of the question is whether the TP rule should be introduced in the form of a directive or through an enactment of the parliament as any other act is introduced. Also, let me ask him about the trends across the globe and what best practices can be observed in this regards. Sanjay sir.
Thank you. Shailendraji, I hope you are able to listen to me.
Yes, sir.
Thank you for introducing me, and I'm really grateful for having me here. Well, transfer pricing, basically, it starts because of the trade and investment in the other countries. So because when the trade happens or the investments happen, it happens so many times. So almost close to 65% of the global trade or transactions happen between the MNCs, a particular MNC. So that's a very large number of transactions. And that's why the countries, and by now about almost like 123 or 124 countries have implemented transfer pricing laws. And more are joining, like Nepal is another one which has joined recently. So basically, when the transactions happen between the two countries, and the countries want to protect its, the profit in their own country, and because the chances are that the MNC, because they are between the same group, they may try and change the prices to their own suitability, either increasing the sale price or reducing the sale price, depending on what the tax rates are. And that is, quite frequent. So the countries countries are bringing the transfer pricing laws and trying to implement that. And another thing, the transfer pricing laws, as and when it comes, it brings a lot more certainty to the investors. It brings them, they understand what is going to happen if I do a particular transaction. So a clear transfer pricing laws and guidelines are very, very important if you want more investment and foreign investment, I mean to say, the trade happens with those between the MNCs, etc. And this is particularly becoming very important because of the global supply chain or the value chain which is obtaining as of date. So overall, the philosophy behind bringing the transfer pricing regime is not to do the compliance work, but to encourage foreign investment and give the taxpayer, whoever is coming and investing, either through a subsidiary in the domestic jurisdiction or some other means of doing that, we are trying to give them the certainty. So that is the basic objective. Coming to your second limb of the question, which was on the whether the directive or the law should be. Shailendra, I have seen more. I looked at many of these countries. I don't think I have figured out anywhere where they have brought the transfer pricing laws as a directive, because directive is not has the same force as a law. So basically most of the countries, as much as I could see, have the law. They would normally bring it in the corporate law, make certain amendments and insert the transfer pricing laws. So directive, which is just a very, very administrative mechanism, is normally not the way that countries bring the transfer pricing law. So I was a little surprised when I saw that Nepal is doing that, but I'll still hold my guns and say that I'll wait for the transfer pricing regime to unfold as and when it happens, because slowly and slowly it will get implemented at the field, and then you may find certain difficulties because it may people may controvert the law itself. The people may controvert the force of the guidelines. So those kind of things are likely to happen. So one important thing, which is most of the countries have done it, is that they have brought it through an act. Because the act brings the substantive, something which has a parliamentary approval, something which has the backing of the law. The guidelines or the directives are largely used for clarification and something else, as a guidance note or something like that, but not to bring the law as such. That's my perspective.
Yes, thank you, sir. We also have similar kind of observations, because at a later date, it can be questioned on its constitutionality because it has not been enacted by Parliament, but that's a question for a later date. Now, moving to the next question. We had a session earlier with the representation from SAARC countries. Now, listening to those presentations, my query to you, Sanjay sir, is about your observation on what is the common denominator which emerges from all the presentations that we have heard so far. And do you think whether there are any best practices that emerge from the practices that the countries have followed in the SAARC region? And if so, then what those practices are? Could you just spell out those in 1 to 3 terms or any order that you may find possible?
Sure. I mean, one thing which I have found, the transfer pricing law is somewhat uniform across the different tax jurisdictions. And similarly, the presentations give me an idea that all the jurisdictions which are there in the SAARC countries, they have almost presented the similar kind of transfer pricing laws structure. The difference typically would be in the deemed associate enterprises, something that somebody wants to cover it a little more expansively and somebody would want to cover it far more narrowly. So that's the only one. Then the definition of international transaction will be somewhat different. But the common denominator, as you are looking for, is that most of them seem to be quite close to the OECD guidance. Of course, between the OECD and UN, there is a UN guidelines also. There is a very little difference, and they are almost runs on the parallel line. So, and this brings a little bit of coherence. Another point that you talked about, I'm not really sure if we all know that SAARC had a limited multilateral agreement on avoidance of double taxation and mutual agreement, mutual administrative assistance in tax matters. Now, this is an agreement that all the seven nations signed in way back in 2005 or six, and then but I don't think it has been implemented as yet. So, if we want an intra South Asia trade and investment, then it will be a very useful thing to make use of the existing framework which all the countries have signed. And if there is a difficulty in accepting what was done a few years ago, certain changes can be done. But that will bring a lot more investment and transactions between the SAARC countries, and which will be good for the region as such, as I see it. And that's why, so that is the second point that I wanted to make. I forgot the last point, the last question that you asked in this sequence.
The last point is, what best practices would you prescribe to the SAARC regions or the legislators in this regard?
Yeah, I saw that. I saw that most of the presentations have quite a bit of dispute, resolution mechanisms. They have almost the same thing, the peer review, and then it moves to the court, and then the tax demand is raised, and then if it's still being controverted, then it moves to the dispute, to the courts, etc., which is fine. But what is very, very important is to bring the dispute prevention mechanism, something like APA, something like safe harbor rules, something have wherever your investments are coming from or you're going for trade, have trade treaties, tax treaties, and make sure that you implement the MAP procedure, etc., so as to remove the double taxation, because that gives a lot of comfort to the foreign investors in the country, and that improves the overall economic benefit to the host nations. And that is something which I would say is very, very important and must pay attention to that. Even in India, by the way, the APA regime as well as the safe harbor came as the presentations was made by the gentleman there from India. He did mention that it came much later, and that gives them on the back foot. By that time, a lot of disputes went and clogged the judicial system, and that's not very good, because it brings a lot more uncertainty about the disputes, and it also impacts the investment and the trade. So I would say that bringing APA regime or bringing safe harbor measures or making use of the tax treaty to make sure that the double taxation avoidance is made, it will be one of the key aspects which all the countries must work on. Safe harbor, even I must say here that while the APA regime is still working quite well, I still have despite I've come from the IRS, but I would want to make a point. It still has they tend to approach is through an audit rather than through a conforming to find a solution. And that is something which I would, tell all the presenters and the people who are from various countries, that whenever you bring the APA regime, the country should bring a regime by which we find a joint finding of a solution rather than finding out a mechanism by which you can do a fresh audit through an APA manual, number one. Number two, in the safe harbor regime, and this is where India was at fault, they kept the numbers at, particularly on the ITS, software development, and the IT-enabled services, they kept the numbers slightly higher. India has almost like 52 or 54% of the GICs of the world. If it reduces the numbers a little bit, there's a good chance that almost like many other GICs which are elsewhere in Mexico or in Indonesia and or in Philippines, they'll move to India because the talent pool is very strong. And there is a good ecosystem which has developed, as you can understand, with 52% of the global numbers being in India. So I would say that while bringing the safe harbor numbers, kindly bring the numbers in a manner that it improves the business and it makes the destination far more attractive for investment and for business.
Thank you, sir. And the follow-up, the next question is a follow-up to the your answer, just you answered. So
Yes.
the countries in SAARC region are in a very developing stage and are looking for investment in their own territories. So in fact, they are net capital importing countries. So what opportunities transfer pricing laws provide or help in getting those investment? Or do you think that transfer pricing laws basically provide revenue garnering opportunities for the country concerned? And the corollary question is, what happens to the basic principle of taxation, that taxation should not distort investment opportunities? So could you just make some remarks on this divergence between investment and taxation, which weighs higher on the weighing scale in the arms of the government? So could you shed some light on that?
Shailendra, the last point I'll take as the first, because that is the crux of the thing, that the tax laws should not be uh, disturbing the investment environment. It should rather promote the investment environment. It's not about giving deductions. It's not about giving allowances. It's not about being a sellout. It's about implementing the law in a manner that it deserves to be, with the kind of philosophy that it requires. And that is very, very important, because otherwise you try and turn away the investors. Because you see, the investments, and we all are developing countries, we are hungry for investments. We want more investments in our country, be it from anywhere. And so it will be very important that we try and create an environment. And this goes not only true for India, but also for all our neighboring countries, which made the presentation here, that the investment environment is such that it creates the tax laws are such that it creates an environment of certainty. It creates an environment of predictability. I should not, all of a sudden a case comes up which disturbs my investment. Then in that event, the taxpayer or the investor thinks that should I really put my more investment in this country, or should I go to some other? Because now most of the countries are trying to give, many countries actually are trying to give a lot of benefits to the to the capital which are coming there, and they are trying to encourage that kind of thing. And that is why I would never consider transfer pricing to be a revenue garnering method. It should be for the correction of the of the prices, be it sales or the purchase, and thereby remove the reduction or the undue advantage that the MNCs are taking. But it does not mean that there will not be taxes. Taxes will come, because once you make the adjustment, certain amount of the taxes will come. But that cannot be the basis for bringing the tax transfer pricing laws. So I am a strong votary of saying that the tax laws should be such that it encourages investment rather than, people say also that tax may not be the foremost item in any board meeting before an investment is proposed. Sure, that may not be, but it's definitely one of the item. And if all the other parameters are very good, but one parameter happens to be on the back foot, then it creates a little bit of disadvantage to the country which is the host country for the investment. So my point is that transfer pricing should not be considered to be a revenue garnering measure. However, because of the adjustment one is made, be it on sales or purchase, there will be certain amount of taxes which will come, you know.
Yes, this is a very tricky question because the government, as at the one hand, needs investment, at the other hand, it also needs revenue to function its daily activities. However, now I would
But
like.
Shailendra, let me mention this, you know, to your last remark which you just made. You know, investments will bring far more jobs. Jobs create its own multiplier effect for the entire
Definitely.
economy. So what you may take as a tax and then use it in expenditure, and government is not the best spender of money. They're you know, the whatever the money is there in the hands of the government, that's not the best. But the corporates may do it far better, you know, in terms of creating, expanding, making use of the goods and services in the own country and giving employment to people. I think that the multiplier effect and the is far more than just taking money out of the transfer pricing adjustment.
Yes, sir. I also second the review that investment has much more multiplier effect than the spending done by the government. Now, sir, I would like to take you down to the memory lane, the time when you were at the IRS in India. Sir, since you have worked in the government and have a deep understanding and knowledge of how transfer pricing laws were implemented in India, which brought the law in about 2001 or 2002, please let us know how the tax department builds its database to have enough comparable transactions. This is particularly important because database is the cornerstone of transfer pricing, and also because this is a new terrain for Nepalese tax authorities and tax authorities elsewhere in SAFA region. Could you share some light on how the tax authorities build this database regarding transfer pricing issues?
So, Sarendra, this is a very, very important question. And thanks to Manoneet, he made a presentation on what kind of database obtains here. The database is very tricky. And when I recall when transfer pricing started in India, the database were really a problem. It has not happened, all the databases, etc., has not happened overnight. It has happened over a period of time from 2001 or 2 to now. By now, of course, a lot of database is available. The tax department also accesses the same database as the private sector does. So it's just the same database. However, I'll come to another topic on the foreign database, you know, which is another area of, you know, very important and which will be useful for this group also. But, you know, and the training, etc., happened through in the training college of the IRS at Nagpur. And OECD provided big hand in supporting the training of the tax officials. But to start with, the training, the learning was not so easy. The learning was very steep. The learning happened over a period of time. Initially, there were a lot of problems. The income tax department also started taking some of the pick up one or the two comparables, and they played on the game of comparable as if the picking up or leaving a comparable to their advantage is the best way to do the adjustment, which is not the best way actually, because comparable is only comes after you have really defined the businesses and defined the FAR, you have done the FAR analysis. So it's very, very important that the database is appropriate to that. There may be a chance, that you may get only one comparable. But initially, the government, the officers did not accept that. The matter went to the court, and then the court also said, even if there is a one comparable, because of the various reasons you have removed the various other comparables, either because of the turnover or because of certain other factors, do take that also as a comparable and fix the arm's length price. Now, this has happened not in one day, because the guidance on that was almost not there, though the government issued very detailed guidance on transfer pricing, how to implement the law and bring those kind of things. But these kind of operational issues were not mentioned in the guidance note which the government had issued in the way back in 2002. So database is a very tricky exercise. Database is something which one must pay attention to. Databases will not happen overnight. Database will happen as and when more investment and more companies operate and they start. And choosing the right comparable is also a very important one. I can give you one example. This was a case of a ITS case somewhere in southern India. And the officers used to love taking that. I don't want to take the name of the company, but those who are familiar with the income tax transfer pricing comparability base, they will probably immediately understand. Because that company had a very high number, the tax department would use that as a comparable, because with that, a lot of adjustments will come. It's like a revenue garnering approach. But then once I was also a DRP member, dispute resolution panel member, which is like a peer review member. And we looked at that particular company and tried to see what is their business. We found that the ITS component is less than 10%. And the balance income, which was not really very high, was coming from a rental income. So that's why the profit margins were very high. And so we dropped that, and thereby we found that this is not a good comparable. So the point that I'm making with this illustration, with this example, is that you have to be truthful while making the comparable. And this goes with the chartered accountants on the corporate side and also with the tax department on the other side. Because if you're not true to the comparability, the disputes will rage, and that's not very good very healthy for the investment and trade opportunities.
Definitely, sir. This cherry picking of the database, especially,
yes,
is quite
and selective cherry picking. Like I choose one and he chooses another one. So the disputes will continue forever. So one thing which I would say is very, very important. Somebody has raised their hand. You want to take his question if he likes.
Let me just run down some questions then. Okay. Now, moving on to the global level, as we know, the world is slowly moving towards an international tax architecture whereby a BEPS 2 pillar has been laid out. Yes. In this regard, the new norm is 15% tax across the globe. Now we can say that 15 is the new 0 because the baseline taxation throughout the globe is proposed to be 15%. In this eventual scenario, do you think what impact will this 15% minimum taxation rate across the globe will impact on transfer pricing regime in SAARC region in particular and the globe in general? What are your take on this view, sir?
So, Shailendra, as I said earlier, many times they reduce the profit or increase the purchases based on the tax rate in another country. And that's the kind of tax planning work that many of the multinationals do. But then if with the minimum pillar 2 providing global minimum tax rate at 15%, there's a good chance, and I'm not really sure because it's still to obtain, that it will disincentivize the MNEs directing profits to a very low tax jurisdictions via that transfer pricing planning. So there's a good chance that we don't know whether it will actually happen or not because people are very smart. They may invent something else, but it will at least create a disincentive because everywhere the minimum tax rate is about 15%, and the pillar 2 says that if you're not being taxed at 15%, then you'll be taxed at a minimum of that 15% in the parent. So you're not going to be scot-free. Either you get taxed in the source jurisdiction where the income is coming from, or you get taxed in the resident jurisdiction where the parent is sitting there. So this Pillar 2 regime implementation may start a very different architecture and a tax regime, which will be useful because it will disincentivize the movement just for the tax rate purposes.
Yes, it's quite hypothetical, but eventually, if this 15% comes into real existence, then this transfer pricing could evaporate. But that's just a hypothetical situation for now.
Transfer pricing will not evaporate because
Means the
it's
planning
not.
through depths and transfer pricing
Yes,
might.
but it's only that tax rate is just one of the items. It's another things also are involved in the transfer pricing. So let's not discount that transfer pricing will go away. Transfer pricing will remain. But then, yes, tax rate will get out of the equation.
Yes, definitely, sir.
So now add a couple of things here, because I think what really happens is if you see the planning which is happening in the Middle East, because Middle East also just launched transfer pricing last year, right? But there is no taxation on individuals there. So 15% even if comes, so people have started moving shift profit through the individuals or to their key management personals. So there are different kind of transfer pricing. So it will keep evolving. It will never die.
Yeah.
Yeah, I mean, many of the tax jurisdictions around the globe, they have they were considered to be the tax havens, right? But of late, because of the BEPS, not only the digital taxation, but also on the harmful tax practices, etc., the architecture has undergone a considerable change. But these are very early days because the regime is still being implemented. Not everything has been done as yet. You may see a very different regime, and believe that they may invent something else. So I don't know about that.
Yes, the tax lawyers and accountants are always ahead of the law. And
yes.
Let's see what happens.
Yes.
Now let's move on to the next question. And this is a very country-specific question. As we know, tax is a very sovereign issue, and the authority to tax is always guaranteed by or granted by the constitution of the law of the land. I have seen that transfer pricing issues are sometimes very complex and tax adjustments are large. Agreement procedures maps are provided for in the tax treaties. What steps would country take so that map could be invoked in case of disputes? And what steps can be taken for timely and orderly settlement of disputes, especially cross-border issues? And can we, as a SAARC region, initiate for an early resolution of disputes without harming tax sovereignty of each countries?
Yeah, at least I did mention about that multilateral agreement,
Yes,
and
sir,
this
that's
multilateral
very
agreement of the SAARC countries is unique of its kind because
Yes,
not many countries. European Union has that, but they don't. But that's done by the European Commission because that's a directive so that uniformity takes place. But the tax treaties are largely what you call bilateral. So countries will have to undertake the negotiations on the tax treaty. So the tax department will have to improve on their capacity to undertake these negotiations. Now, these tax negotiations and the tax treaty negotiations are hard. It's not that very easy to because the countries, whoever is the competent authority or his team comes very well prepared to bat on behalf of the companies which are, let's say, situated in their country. So the tax treaty, though it's a good vehicle, but it's also very hard vehicle. So, but nonetheless, as slowly and slowly countries pick up their experience and capacity, and they make sure that the tax treaties are used for removing the double taxation aspects. Because double taxation means that if I pay X amount, in the other country, I pay whatever be the tax minus the X amount. So my tax, the overall tax payment reduces substantially. If there is no double taxation treaty between the two countries, I pay X amount and I pay R amount on in the resident side, then the total tax becomes R plus X. So the double taxation treaties are very, very important. And just to promote the SAARC countries, as you mentioned, as I mentioned, there is already a treaty, multilateral treaty, but we have not actualized that. We have not implemented that. Maybe time like that has come. If everybody is ready for that, everybody has the right, inclination to do that, it will be a good way forward, because there is a lot of potential within the SAARC countries to do a lot more investment, and thereby gain in the economic development.
Yes, sir. That was, I think, very proactive steps taken by SAARC countries, though the SAARC region and the treaty that you have talked is in hibernation. Let's hope.
It's been forgotten, actually.
It's in hibernation. Let's hope someday it will wake up.
Yeah.
Okay, now I think I'll direct my last question to Sanjay, sir. Since safe harbor rules are also the part and parcel of TP regime, and India has a varied experience with safe harbor rules, can you share the Indian experience regarding safe harbor rules, and what suggestion would you provide to SAARC countries in drafting these rules in the backdrop of Indian and global experience and experiments?
Shailendra, as I mentioned earlier, the safe harbor rules, there are very few companies which actually go for the safe harbor rules in India. Why? The reason is that the numbers which have been given there are far more in the audit and in the judicial the judicial resolution. The numbers which are comparable numbers which are given are much lower at times. So not many companies, but then what it does is it just clogs the whole the audit cycle and the judicial cycles, and it's not very good. The idea is that the safe harbor rules should be such that it is there are more takers for that. India started with determining the safe harbor rules very well. It created a committee. They went into a lot of economic analysis, a lot of business analysis. They have about 9-10 transactions on which the safe harbor rules have been brought in. That initial part was very good. But then when it came to the government, they probably did not agree with many of the numbers which the committee had given, and they brought their own numbers. And the safe harbor rules are, the numbers are mentioned by the CBDT, which is the apex body for doing this, almost every year, or sometimes they extend the previous year number. But what it does is that it has not benefited the companies in a really big manner. It will be very, very important that safe harbor rules are kept in a manner that it provides enough encouragement to the company to adopt the safe harbor rules. At the same time, it does get a certain amount, because ultimately, why you bring the safe harbor rules? You bring the safe harbor rules because you want more companies to come and do business in your country. So keep that objective, the bigger economic aspect, economic development aspect in mind, and bring those rules rather than use that in a very, very fancy, disruptive manner and create a problem for yourself. That's how I will say.
Okay. Okay. Thank you so much, Sanjay sir, for your expert knowledge and knowledge sharing. And in future, we'll again get back to you for picking up jewels from the vast ocean of your knowledge. And definitely your guidance and knowledge will help us as well. Thank you so much for your time and patience. Thank you, sir. Now, I think few participants have left the discussion, but now I would like to direct the question to the expert from Pakistan, Mr. Muhammad Raza, if it is there. If he's there, Gaurav sir.
Yes, I'm here.
Okay.
Yes, yes.
Okay. Mr. Muhammad Raza, expert from Pakistan, laid out the experiences of Pakistan in his highly erudite presentation. One specific query to Mr. Raza is that he mentioned in his presentation that Section 79 was introduced in the Income Tax Ordinance 1979. However, no guidance note or rules were issued in this regard. Only in 2001 ordinance, section 107 was added, which dealt with the TP issues generally, specifically. Moreover, in 2016, as per his presentation, the documentation requirement was expressly added. So, in this scenario, how was the uncertainty or ambiguity, especially the absence of what course of action to follow, as was perceived by the business community in Pakistan, and how did the courts interpret this local vacuum, this legal vacuum? So, could you share your light on the ambiguity in the business sector and the course followed by the courts in this regard, the vacuum created due to the absence of the rules or the regulations for such a long time?
Thank you very much. You see, in that era, the only major dispute which arose was in relation to the pharmaceutical sector, where raw material imports data was compared with the customs data available for comparable transactions, and tax authorities tried to make adjustments. When that dispute went into the appeals, the taxpayers, being multinationals, they tried to educate the appellate fora that this is an international subject, there is an international material, and since the transactions were carried out by with an associate which belonged to a jurisdiction where the transfer pricing regulations were more advanced and there were documentation requirements in that jurisdiction, so they tried to justify their case relying on the transfer pricing data or documentation of the corresponding country, because on a group level all MNCs were then even following some documentation requirements, and then that created an expectation in tax authorities that even though our rules are not very clear, whenever we are picking up any transaction for scrutiny, they were expecting that being a part of a big multinational, known company, the group at least would have some documentation to justify that they have not made any arbitrary pricing for the transactions with associates. Rather, there is some basis for that.
Or rather, the court trusted the taxpayers in this regard.
Yes, the other thing was that obviously there were a lot of technicalities involved, in developing economies. When these kind of disputes go to the courts, we being part of that fraternity, we all try to build our case on certain technicalities, that when there is no express rules, then the ambiguity should be resolved in the favor of taxpayer. Yes. Then obviously for the data, that if that data is not publicly available to a taxpayer, how can you expect him to make his price based on that data? Then comparability analysis. So all those kind of arguments which were internationally available, we all used that, and courts and appellate fora were appreciative of those arguments because this is an international subject, so they had to seek guidance from international material.
Okay, thank you, sir. And as I think we are heading to the end of our presentation, I would try to limit my questions, just a question to each presenter. But well, may I take the liberty to ask a second question to Mr.
Yes,
Radha? This question is specifically taken from the chat box. Mr. Usman Jafar has raised the question that what is a provision in MLA / DTT regarding the transfer pricing, whether it contradicts with anti-avoidance provision of income tax laws? Secondly, what impact transfer pricing provision have when a group is taxed as a single payer? This is his question as he put it in the chat box. Some lights on this question, sir.
I think as far as Pakistan tax laws are concerned, there is an express provision in the law that wherever there is a double tax treaty and it contradicts with the domestic law, the double tax treaty always prevail. There have been a number of disputes in this regard in the past, and even up to the Supreme Court very recently held in a number of cases that wherever there is such a conflict, the treaty provisions would always prevail. Obviously, we have not yet seen a case in relation to the conflict of double tax treaty provisions with transfer pricing or anti-avoidance, but I feel that the same principle will be followed. The only thing is that in our law, an amendment has been made that it is now subject to general anti-avoidance provisions. So there is a case that unless it can be substantiated that a particular entity was created in a particular jurisdiction having no substance, no commercial reasons, and it was only created for tax avoidance purposes, then there is a question that double tax treaty supremacy may be questioned. But this particular case has not yet arisen. I'm aware of one or two cases where the department at a lower level has took this position and there are disputes. But I think this is an area which will be evolving in futures. And I think with MLI, Pakistan has adopted principal purpose test and other tests to ensure that if a foreign entity is invoking a double tax treaty, it has to substantiate that there were non-tax reasons to establish its entity in that particular jurisdiction, and it's not merely for tax reasons. The second question regarding the group taxation in Pakistan, there is a concept that only local entities, if they are part of a 100% owned group, they can opt for a single fiscal taxation as a consolidated unit. And in that case, the holding company is taxed on the income of all subsidiary companies. So technically, all intra-group transactions stand eliminated if the consolidated group return is filed. But having said that, the rules say that even though you will be taxed on a single fiscal unit, you have to ensure that all intra-group transactions are done on an arm's length basis, which implies that the legislature still wants to see that on a standalone basis, your transactions should be seen on an arm's length basis. Maybe it's more of a procedural requirement, because if you are entering into a group taxation, it becomes more of an academic exercise to see whether there is an arm's length procedure followed or not. But this is the requirement of law. Maybe legislature wanted to have in their own wisdom to ensure that still, even under a group taxation, people do follow arm's length standard. I hope I have answered both questions.
Thank you, sir. Thank you so much for your answer. Now, I would like to move on to the presenter from Sri Lanka, Madam Tilak Ratne. Thank you, Madam.
Hi.
I hope your net is working well now.
Yes, thank you. Sorry about it.
Okay, Madam, thank you for a highly erudite presentation and your presentation on Sri Lankan experience. As many of the listeners here are professional practitioners or auditors or tax auditors, as whatever name you call, I would like to place a question from our perspective or the tax auditor's perspective, that what challenges did tax or transfer pricing auditor face at the initial stage of introducing TP laws in Sri Lanka? And what challenges do auditors face in the backdrop of ever-changing laws, especially in TP law, as it is evolving? And could you share some light on this topic, especially from an independent or tax or financial practitioner's perspective? Over to you, ma'am.
Sure. So initially, when we started, I think the biggest challenge we faced as TP practitioners was that, here in an international transaction, we sometimes deal with another party of another jurisdiction where they have mature TP practices and they've implemented TP for a fairly long time. And then on this side, we've just introduced the regulations, and we find that some of the practices are not accepted by the revenue authorities locally. And it's two sides of the same coin. So it's not that we can ignore our practice, ignore the practice of the foreign jurisdiction and just apply what we think is relevant to us. Transfer pricing is two sides of the same coin. So the biggest challenge we faced was the time taken by, I think, our local authorities to sort of be in line with the developing regulations worldwide. One of the biggest examples, and I mentioned it earlier, was this transfer pricing adjustments, which the local authorities don't recognize, even if it's done in their financials and before the year-end closure. But it's a practice that is, adopted globally. I mean, it's in as much as we want to be in conformity with arm's length price, the other party in the other side of the transaction also has to be at arm's length price. So if we are enjoying super profits, which we're not supposed to based on our characterization, then of course our profits have to be adjusted down. It does not mean that, we are shifting profits. it's to ensure that both parties at arm's length. So we face a lot of challenges like this, trying to explain the global practices, global regulations, and I guess it was mostly because of the failure to have a succession planning within the local authorities. Where once they are trained, they either retire or they move to another role, and then there is no one to take over, and we start back again from square one. So those are the biggest challenges we face. And in addition to that, we don't even have an alternative dispute resolution mechanism where we can preempt any disputes by going in for an advanced pricing agreement or a safe harbor rule. So that is also not available to us. And when we don't adopt the global practices, then we face the challenges in doing business with other multinationals from other jurisdictions. So that's like the biggest challenge I think we faced.
Yes, madam. There are many challenges for us.
So I have
Thank you,
actually
ma'am.
a counter question for ma'am.
Yeah.
Ma'am, is it they don't allow adjustment because they want cash repatriation, cash back into their country? Is that one of the reasons that you have seen last couple of years?
No, so anyway, we have a rule under our exchange control regulations where the cash has to be repatriated back to the country within a certain number of days, especially where it's export proceeds. So it's not really with respect to the cash repatriation. It's more they see this line item where an adjustment is made and that reduces the profits. Had that line item been disallowed, profits would increase and they can tax it. So it's not really more on cash repatriation. It's more on they feel it's a mechanism of bringing the profits down in Sri Lanka.
Okay, so because in India we have a secondary, primary, and secondary adjustment. So they make a primary adjustment. You can voluntarily make a primary adjustment even by
Right.
and if you don't bring that money into India, then you can actually have to pay interest, which is a secondary concept. So my gut feel was, I think that might be one of the reason of them not allowing such kind of, because they wanted foreign forex to come back to Sri Lanka, might be.
So not really. So we have a rule for exports where if you export within 6 months, you need to bring the money back into the country anyway.
Okay.
So it's not really surrounding that principle. It's merely they see this line item of an adjustment, which effectively reduces the profits, and they think it's reducing the potential tax collection.
Fine, thank you.
Okay, thank you, madam. Now, the presenter from Maldives, Susan Said, madam, is she available? Madam, there. Thank you, madam. Question to Mrs. Susan Said is that, as you pointed out in your presentation, and as we all know, that Maldives is mostly dependent on tourism industry, and the tax authorities in Maldives must be rich in this data. But the question is on the flip side. It is regarding non-tourist industry. If you have any other industry that are not tourist industry, how are the tax authorities in Maldives dealing regarding the database of comparables in the non-tourist sector? Can you share some Maldivian experiences in this regard, especially the data collection on the non-tourist side of the business?
Thank you so much for the question. So mainly, like I said, it was tourism, but we also, the next industry that we have is fishing. And when it comes to fishing, we do have some companies where they export to associate parties. So again, the database that we have, which is TP Catalyst, so we are able to filter those companies that are involved in fisheries products, and we can compare the benchmark. For example, if we take up CLI as operating profit or over something, we are able to compare that with our taxpayers. But we do not have like manufacturing or mining as such in like those kind of difficult comparable industries here in Maldives. And we also have, like I mentioned earlier, we have those data which we get from customs, our customs authority, but we actually don't use it as much in our adjustments because they are secret information, to which we understand that the taxpayers do not have access to. And also, yeah, that's it. Thank you so much.
Okay, thank you, madam, for your answer. Now, as we are running out of time. My final question to Mr. Mononit Daralji. Since Mononit ji has a wide and rich experience in providing advisory services to private companies in maintaining and building competitive data, what suggestion would you give to private sectors in complying with TP laws in maintaining contemporaneous data sets? How should private sector navigate this complex challenge? Some words on this, sir.
One thing is definitely the data is, at least in last 2 3 years, more data is available.
Yes,
So if
definitely.
you really see the data generation and the data comparability that has gone up in last 2 3 years at a global level, and it's more data generation from this SAARC region also. Right, so there is a good amount of data, and apart from public limited companies, yes, the data is a little bit of issue. And if I really talk about the region, because it's apart from Bangladesh, where you can find data on payment of fees, but there also you need to go manually. It's very difficult to get those kind of data from the region per se. But if you apply a regional database, because condition, the moment you talk about a particular kind of enterprise, and if I am doing a Bangladesh, or if I'm doing Sri Lanka or India, there is not much difference as such as the geography is concerned or the competitiveness is concerned. So we can apply for a regional database here as such also. And those are available at a pretty cheap level. If you go for a specific benchmarking, 25 30,000, you will Indian rupees, you will find a benchmarking. So those are not very expensive way of doing benchmarking. So I think the idea way is to do a contemporaneous benchmarking at that point of time. Because though I know there is a filing, but the way I have seen working, at least in the region, is people do wait for until it's being called upon by the tax officer to do the benchmarking. And frankly speaking, there is not much tax audits apart from India. If I really talk my direct experience with region per se, there is not much transfer pricing audit that is really happening. That's the reason the transfer pricing laws have not been implemented, and that's the reason there is no database development also happened.
Yes.
So
We are
that
at very nascent stage at other countries.
it's a nascent stage, as well as there is somewhere of a willingness of the I think authorities also to implement. Might be because of the too much pressure from those countries or the companies which gets scrutinized, because they have direct indirect connects to put that kind of attention towards scrutinize us on those things. So they have, because they actually, I think, somewhere try to put that kind of also blackmail that you want our investment or not. So if I put it very
Not
simply.
only that, but because we are yet just implemented the transfer pricing laws, I think it will evolve over time.
Yes, and I think that only looking transfer pricing from a tax perspective is a misnomer, that because transfer pricing is a very good and defined tool in management. It's those, as a chartered accountants, as a lawyer, we look at transfer pricing only from a compliance or a litigation perspective. But otherwise, it's a very good tool to do a overall management of a company, how to completely take care of the value chain, how value chain should be really working. So those are the real tools. That's why I said when I mentioned my presentation, only for the first two things was only on the database, on the transfer pricing, on the industry and company analysis. So rest 7 points were how transfer pricing actually used within the management itself. It's a management tool actually. Transfer price became a tax subject later on. It was a management tool first. So US has transfer pricing in 1960s. It's not because they were taxing only for the purposes. It's actually they were trying to understand how their companies are growing global, and then trying to do business. And then accordingly trying to incentivize that. Right? If moment you get a transfer pricing report, you get to know how a company is making profit. You can utilize, a country can actually utilize that report to inventorize those kind of transaction. So those are actually a real tool if they really want to. And because tax is nothing but a partnership which most of the sovereign usually have, right? It's not something you need to take out of them. It's a partnership. Your 25 30% is nothing but your partnership of the profit. So if they work in that direction, definitely they will make huge profits.
Yes, sir. I definitely second your opinion that TP is a cross-cutting tool rather than just a tax issue. And
for the entire group here, I can say the benchmarkings are pretty simple, easy, and they can even approach me directly, and I can help anyone for
okay,
any.
thank you, sir. In the future, we'll definitely get some services and help from you, definitely. And I think the listeners and participants will definitely help from your services. I think we have come to the end of this session because we are running out of time. Now, I think Gaurav, sir, should we take more questions or shall we put a stop to the questions? Because there are many questions in the chat box as well. Gaurav, sir. Oh, Surendra sir is. Okay.
Surendra sir, we can take one or two questions if there are from the chat box. We'll
I
also
think
let you
Sandesh
know.
ji has a question. Good evening, sir. I have a question on possibility of TP between HO and branch transaction. HO and branch transaction. I think let's not delve into this specific issue because I think Gaurav sir.
Okay, then,
Okay,
Surendra sir, we can
let's end this.
conclude this session.
Okay, thank you so much for providing me this opportunity for moderating this session. Thank you.
Thank you. Thank you very much, Shailendra sir, Sanjay sir, and all our STEM speakers for gracefully conducting this Q&A session and this entire webinar. As we draw near to the conclusion of the webinar, I'd like to take a moment to express our deepest appreciation to each and every one of you for your active participation and insightful contributions. Throughout the course of this webinar, we have engaged in thought-provoking discussions, exchanged valuable ideas, and forged meaningful connections that will undoubtedly propel our collective efforts towards transfer pricing. Before we officially conclude, I would like to extend a heartfelt thank you to all our esteemed speakers, all the participants, not only from Nepal, but from entire South Asian region of this webinar, and the SAFA Secretariat for their continuous support, dedication, and hard work in making this webinar a resounding success. As we prepare to wrap up this momentous event, I now kindly request CS Surendra Bhushan Shrestha sir, Executive Director of ICAN, to provide his closing remarks reflecting on the key takeaways and highlighting the actionable insights gained from our discussions. And with his speech, please allow me, Gaurav Khateoda, your very honored host for today's webinar, to sign off for today. Namaste and thank you. Over to you, Surendra.
Thank you. First of all, I think this has become a very long session as such, but I think this session has given us understanding of how transfer pricing guidelines have been implemented in the SAARC region countries. First of all, I would like to thank Dr. Sunil Devkota, Chairman of SAFA Committee to study fiscal regimes and other statutory requirements of business in SAARC countries, and Council Member of ICAN, for your opening remarks and providing valuable insights on the importance of implementation of transfer pricing provisions in SAARC region. Secondly, I would like to extend my sincere thanks to Sri Praveen Kumar Jha, President of ICAN, for highlighting the recent transfer pricing guidelines enacted in Nepal and the challenges in implementation of the provisions. I would also extend my sincere thanks to Neil Bahadur Sarumagar, Vice President of ICAN, for shedding light on challenges and specific provisions on implementation of transfer pricing, including transfer pricing audit. And as we went on through the first technical session, where we had presenters from different SAARC region countries, I would like to thank Mr. Sabir Ahmad, Council Member of Institute of Chartered Accountants of Bangladesh, for sharing Bangladeshi transfer pricing guidelines and transactions between associated enterprises, international transactions, allowable methods, OECD requirements. I'd also like to extend my sincere thanks to CA Siddhartha Banawat, representative from Institute of Chartered Accountants of India, for highlighting on how transfer pricing has evolved at par with international framework from developing countries' point of view. And also he also highlighted provisions on specific domestic transaction, asset and risk analysis, stages in TP assessment, and key issues on transfer pricing dispute. I'd also like to extend my thanks to Mrs. Sasun Said, representative from Institute of Chartered Accountants of Maldives, on highlighting on transfer pricing rules in Maldives and arm's length price principle, income tax return schedule, advanced pricing arrangements, mutual agreement procedure, common practices, and challenges faced, including information gap. I would also like to extend my sincere thanks to CA Sailendra Upreti in shedding his light on the recent TP directive issued by IRD Nepal, and he highlighted the chapters of TP directive, including rationale of directive, TP and other arrangement between associated parties, comparability analysis, method of arm's length price determination, transfer pricing, documentation and administration, and states on the need to address on absent provisions such as APA, safe harbor rules, and intangibles. Further, I would like to extend my sincere thanks to Mr. Mohammad Raza, representative from Institute of Chartered Accountants of Pakistan, for highlighting on evolution of transfer pricing legislation in Pakistan, including concept of associate, penalty provisions, determination of arm's length, country-by-country reporting, and specific provisions relating to loans, TP controversies in Pakistan. And I'd also like to extend my sincere thanks to Charmaine Tilakratne ma'am for representative from Institute of Chartered Accountants of Sri Lanka for highlighting on transfer pricing provisions and its involvement from 2006 to onwards, overview of transfer pricing regulations in Sri Lanka, and mandatory provisions of country-by-country rating and assessment procedures and key issues in transfer pricing legislation. And as we went through the second technical session, Mr. Munonit Dalal, sir, director from EXA Exports as subject expert, I thank Mr. Dalal for highlighting on transfer pricing and database, challenges on transfer pricing and way forward. He highlighted on requirements of TP database, different approaches of searches, stock exchange information, and TP regulation status and database availability. He also highlighted on the identification of initial list of comparable companies and source of data, company-wide information and transactional data, and also challenges with the transfer pricing databases and solution and way forward. And in the third technical session, our former IRS officer and ex-partner Deloitte India, Dr. Sanjay Kumar sir and Sailendra Upreti has a I also extend my sincere thanks to CA Sailendra Upreti for moderating the session, and our prominent speaker, Dr. Sanjay Kumar sir, for providing clear understanding on the rationale behind TP regulation and emphasizing on the requirement of requirement to have a law rather than directive in Nepal, and also for emphasizing on best practices such as EPA, safe harbor rules in SAARC region, and also for highlighting tax law as a promoting investment rather than revenue gathering method, and for sharing and highlighting on how databases have been built in a period of time in India, and on throwing light on bilateral double taxation treaties and the potential of investment in the SAARC countries, and sharing experience of safe harbor rules in India. I also would like to thank our esteemed speakers and the participants for their valuable contribution in making this webinar success. Once again, I thank all the distinguished speakers, participants for adding immense value to this forum by providing valuable contributions and efforts in making this webinar a success. Thank you all. I look forward to meeting you again in future initiatives. Thank you. Namaste. Good evening.